He's out to 7 at Bank of America. Nomura has an interesting call. They're at 5, but that first move is a 50 basis point hike in March. So, Lisa, there is one single bank out there looking for that 50 basis point hike in March, and it's Nomura.
Honestly, you've heard one Fed official after another explain why a 50 basis point rate hike is highly unlikely. And there was a column out this morning from Bill Dudley basically saying the same. They don't want to shock markets, and yet, you know, there are those who believe it.
I've got no idea what happens this year. It's a guessing game. I keep stressing that. It's messy. Why? Mike Wilson and Morgan Stanley Tom put it perfectly. The safety net of forward guidance is gone. It is gone. It's a big change.
Yeah, it's a big change. I'll go with that. And the description of the Powell put, if you will, is maybe being reformulated. But the arch question, John, is how do you raise rates into a slowing economy? I mean, that's the, you know, the Econ 101.
That's the risk, DK. That is without doubt the risk. And when you see the inflation numbers start to weigh on consumer confidence the way they are currently, like we saw in Friday's number, that's the worry. But this Federal Reserve's not going to hold your hand like they held your hand through most of the last 10 years or so, Tom.
We're going to have to see. There's no question about that. Futures at -10, Dow futures -38. The VIX in nicely, 25 level into 24.87. It is an appropriate time to speak to Elsa Lignos, Global Head of Foreign Exchange Strategy at RBC. Elsa, just as a general statement, the idea of raising rates into a slowing economy, whether it's a Goldman Sachs stunner overnight on an adjusted GDP well under 2%, what does the dollar tell you? How do you preview the deepest market over the basic idea that we're raising rates into a slowing economy? How do you use the dollar there?
So what's amazing is that despite the volatility we've seen in a lot of other asset classes, whether it's rates or equities, FX vol has actually been relatively well behaved. And, you know, from that you could surmise that investors are obviously very mindful, but not massively worried at this stage. You know, we're looking at euro-dollar, for example, which is trading well within a range, trying to push a bit lower, then you get interest to the top side, but certainly not sending warning bells that the Fed is making a massive policy error here.
Is there a bet right now within the mix of flows of big money and the relative interest rate story? Is there a bet where the street is overplaying in foreign exchange?
If anything, underplaying it. You know, I think part of the problem, I guess, for FX vol is that currencies are not massively misaligned relative to longer term measures of fair value. I mean, certainly there are currencies out there that look cheap or expensive, but this isn't like the 80s where you had some incredibly rich or incredibly cheap currencies and they were the escape valve. And I think, again, you know, currency markets are telling us that you don't have that same level of concern that you might see in other asset classes at the moment.
Elsa, how much is this really driven? And I'm thinking particularly of John's point earlier about emerging markets and the strength that you've seen, the resilience in certain currencies. How much is this driven by the commodities boom? The idea that some nations, a lot of these nations, will actually do very well in the face of that?
That's definitely a big part of it. And the other thing is just pure valuation. You know, a lot of these equities are actually very cheap. And particularly if you look at some of the biggest underperformers year to date, it's the ones that have done so well in the last few years, where you've seen huge amounts of retail money in particular bidding up these stocks. And now you're seeing some payback. So emerging markets are the flip side of that. You know, it's where they've been somewhat unloved, and couple that with the commodity boom that you highlighted. And that's where you have the result today.
So we've been talking about this sell-off, the correction in the S&P, the correction in the NASDAQ. A lot of people are buying this dip, as we saw over the past 2 days. And you're talking about a lack of fear in the foreign exchange markets. Do you think that this is slightly misguided, considering the tightening cycle that we're in with respect to developed market banks?
Look, I think, you know, you summed it up earlier very well, saying we've lost forward guidance. So we no longer have central banks telling us exactly what they're going to do. But we didn't used to, if you go back enough years. I mean, this is only a post-GFC phenomenon where central banks have really held our hand and told us every step of the way what they're going to do. And if anything, the fact that FX markets are not reacting a little bit more violently is that we still have a fair degree of central bank forward guidance still out there. So I think you could call markets cantankerous and reacting badly to some of the kind of year-to-date, we're going to be hiking rhetoric from central banks. But certainly if you look for fear, it's not there right now in effect. Certainly lots of other things that could provoke it, but it doesn't look to be central bank tightening.
Elsa, early in the morning here in New York, and yet we have not focused on ECB and the incredible political challenges that Christine Lagarde has. How have her political challenges changed with higher inflation, which makes many, such as Germany, afeared?
It's a great question, Tom, because I think if you look at Christine's job over the last few years and before that Mario Draghi, they benefited from the fact that inflation never really picked up. And now they're in this situation where you look at spot inflation that's very high, but they still don't see the underlying inflation pressures that would sustain that. So it's a very difficult path to navigate. We still think the market's getting a little bit ahead of itself, but I know it's a very popular narrative out there that the ECB has to act sooner and faster, just given some of the spot inflation numbers.
Is the market ahead of itself in America? I'm really taken aback at Lori Calvasina's equity optimism at RBC Capital Markets. Is the Fed game ahead of itself where stocks go up because the Fed slows down?
And I think John hit the nail on the head earlier when he said, there's a lot of uncertainty out there. And when you come in with a call of we're going to get 7 hikes this year or 8 or, some of the higher numbers being thrown out around there, I mean, it's certainly not outside the realm of possibility, but it's not a base case scenario. The 50 basis point in March, that seems very unlikely to me. I mean, let's not forget, this is a Fed that's still doing one more month of QE. Doesn't look like a Fed that's going to hike 50 in 6 weeks. So, when I put it all together, is the market getting ahead of itself on the Fed? No, I think it's, quite reasonably priced. The RBC call is for 4 hikes. We'll see how that shapes up as the data evolves.
So I'm looking right now, just to finish up with one of the more popular topics on this show, Boris Johnson facing new pressure today. And of course, I go straight to predict it, to figure out what the chances are that he will remain prime minister through May. It's now 63% saying yes, and 39%. It's not really evening out for predicted. So I'll try to figure that out. But from your perspective, what is the price consequence in the pound that you expect should he be evicted from his seat?
I think if you were to go back a year, it might have been a bit more clear cut. And part of the reason why investors are trying to ignore this, partly because it's just too painful, we're all fed up of it, but also because the outcome is not so clear in terms of the pound. It really depends whether you get a PM Sunak, a little bit more fiscally conservative, a PM Truss, not exactly clear what kind of PM she would make. And I think from the sterling perspective, we really don't have a clear guide as to what the successor would mean for the pound. We revert back to Bank of England pricing, and it does look like, again, market getting a little bit ahead of itself.
On to the Bank of England on Thursday. Elsa, wonderful, as always. Elsa Linios there of RBC on this FX market. And the central bank still to come away from the Fed. The ECB and the Bank of England this coming Thursday. For the ECB, Tom, just how low is the bar for the ECB this year to surprise to the upside? It's a very different story compared to the Federal Reserve.
It's a different story, and as I mentioned, it's the politics of the story. Germany hasn't confronted this inflation. I'm sorry, I'm old school on this. To me, it's a third rail in Germany to see inflation like this. Sebastian Malaby scheduled to be with us on his wonderful new venture capital book later this morning, John. And I can't wait to talk to Malaby about the Germanic thrust on inflation. It's original.
Well, let's talk about rents here in America, Tom.
Wow.
Just how important is that story for the year ahead?
Matt Boesler just killing it. I mean, it's a huge story. And folks, this is the read of the day without question. I like, John, how he parses it from Phoenix down through Miami, down to where the rents really haven't moved. John, are you aware that New York is one of the cities where rents haven't moved?
I was not aware of that, Tom.
I was not aware of that.
Wow.
I thought they had gone up, here in Manhattan at least. Anyway, Tom, I know they have.
I don't know. All I know is it's a must read here. And the number that settles out, would you agree, Lisa, is 5% plus?
Yeah, basically that's the prediction for this upcoming year, is that inflation could go to 5% plus on average. But there are differentials within the country because the places that saw the most in-migration saw rents absolutely surge, whereas New York only saw a 1% increase in rent. But it's different depending on whether it's a doorman building. So, John, that might be why there are questions from your end.
Yeah, I mean, John, I haven't experienced that in the walk-up I'm in.
I know, Tom. That walk-up's tough, isn't it?
Oof.
To the 50th floor. To all 50. Although I remember when one morning Tom actually walked down.
Actually, the walk down, folks, is tough. When the elevators break twice a year, the walk down is enough to kill you.
The one morning Tom came in about an hour late. because he had to walk down about 50 floors.
My legs hurt for 5 days
So they
after
still
that
hurt
walk
now.
down.
TK, just quickly, UPS up a little more than
That's
5% in the
extraordinary.
pre-market.
Yeah, up 6% earlier. It's given away a little bit. John, this is a huge, huge deal. Every single buy-side house has to reset off what UBS, the sum, the tone from UPS is amazing.
Higher pricing, posting profit above analyst estimates, big boost to the dividend. Stock market likes it so far, up 5.34% with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Just a bit softer to kick off February. We're down 0.25% on the S&P. We are down a similar amount on the NASDAQ 100 from New York City for our audience worldwide. It's a beautiful one in New York. Good morning to you. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In the UK, Prime Minister Boris Johnson is again under fire from members of his own Conservative Party. A report into partying in Downing Street during lockdowns slammed failures of leadership at the top of Johnson's government. Johnson promised Conservatives he will get back on track, but many of them are not convinced he can turn things around. Meanwhile, police are still conducting their own investigation. The Winter Olympics in China may be more of a drag on Beijing's regional economy than a boost. COVID flare-ups and pollution curbs are weighing on consumer and industrial activity. A ban on public spectators means there won't be the usual bump up in tourism that a city hopes to gain from hosting the Games. The Olympics will begin on Friday. In Texas, Governor Greg Abbott faces a crucial test of whether he and Republican lawmakers have done enough to shore up the power grid, and it comes weeks before his party's primary vote. Temperatures are expected to plummet on Wednesday with sleet and snow in some parts of the state. Almost a year ago, a storm forced power plants offline and left millions in Texas without heat for days. And UPS benefited from those high prices and rising holiday deliveries to post profit that beat estimates. The package carrier also came out with an outlook for this year that was better than expected, and UPS boosted its quarterly dividend by 49%. Bloomberg has learned that the Federal Trade Commission will handle the antitrust review of Microsoft's proposed $69 billion acquisition of Activision Blizzard. The review will focus on the combination of Activision's gaming portfolio with Microsoft's consoles and hardware systems. The FTC has promised more aggressive policing of deals. Global News 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Did Delta fundamentally change the sort of infrastructure of hospitals and medicine generally in India, or was this just a short-term phenomenon and things reverted back to the mean?
So it did change. I think from a preparedness standpoint, how the hospital infrastructure sort of geared up for it, and whether it was oxygen requirements. I think most hospitals have put up liquid oxygen plants, temporary plants. Some have put up permanent plants. I think the capacity for oxygen and other, medicines and supply chain has been augmented, enhanced. So from that standpoint, I think there's been expansion in capacity in infrastructure. We've all sort of seen how far we can stretch the envelope.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think the national mood will really start to change as deaths come much further down. We are going to see COVID start to fade a little bit more into the background. I don't think we'll have nearly as much disruption in our lives in 2022, barring the emergence of something that we haven't anticipated, which of course could still happen.
Dr. Joshua Sharfstein there of the Johns Hopkins Bloomberg School of Public Health, the Vice Dean from New York City with Tom Keene and Lisa Brambitz. I'm Jonathan Ferro, waking up to February and leaving behind an ugly month for the equity boost. I practiced that last night for you, Tom.
This is good.
No, anytime. Futures down 1/4%. I'm just pleased it's appreciated. On the S&P, on the Nasdaq 100, we're down 0.2%. Yields in 3 basis points to 174.83 on 10s. Tom, after a big shift higher across the curve to start the year.
John, we haven't talked about this yet. Let's take 2 seconds here. Brent crude, 91. Okay, right now it's 89.17. But to me, John, that's the shock of January.
Strange things happen, Tom, when crude gets to these levels.
Exactly.
The last time we were here. Thank you, Tom.
Well
Again, we've been kind to each other this morning. When you go back 8 years, the last time we were here to 2014, late 2014, it was October. A month later, a market share war started, sparked by the Saudis. Strange things happen when you start to breach $100 a barrel.
Let us do this. Let's move to the pandemic right now. And what we're going to do is focus on Beijing. Amish Adalja, we're the senior scholar at Johns Hopkins Center for Health Security. And I'm going to suggest, Amish, that you have been a critic of the Chinese policy on the pandemic. How does that nation dovetail its stated policy with people, thousands, descending upon Beijing?
They can't. It's a contradiction. It's inevitable that they're going to get COVID cases, especially with the Omicron variant, its ability to evade immunity, and some questions about the efficacy of the Chinese vaccines. All of that is going to cause a perfect storm for their COVID zero policy. It's going to be shown overtly to be untenable. And unless they kind of resort to the authoritarian measures that they have throughout this pandemic, it's going to be something that the world is going to see, and their population is going to see that this was not a sustainable approach to a virus that was always destined to become endemic.
If you advised Olympic authorities and, quite frankly, NBC, with billions involved in broadcasting, all the other broadcasters worldwide, what would be your advice to Olympic management, Olympic staff?
My advice would be to expect that you're going to get cases, to use the tools we have, rapid tests, making sure people are vaccinated, having antivirals on hand, and then also to push back on Chinese policies that kind of are premised around this idea of COVID zero, and to really at all points not accept any kind of authoritarian measures that may be put into place in that setting. I would really be vociferous about it, because I think that they need to understand that this isn't the way that you handle an endemic respiratory virus, especially in 2022 with all of these tools. And
Dr. Adalja, let's move to the other side of the extreme. South Africa came out and actually removed self-isolation for those with asymptomatic cases of COVID. Do you think that that's appropriate, taking a step to that place?
Eventually, we're going to manage COVID-19 much like other respiratory infections, where we sort of have the honor system and we tell people isolate when your symptoms abate. And I do think we're heading that way towards COVID-19, and that would be probably one of the things that happens when we start managing this like other seasonal respiratory viruses. I think it's hard to completely do that because we still in the United States have too many high-risk people that are unvaccinated, so we still want people to make sure they're not contagious. And this is where I think if someone's asymptomatic and their rapid test has become negative earlier than those 5 days that the CDC recommends, you can think about, I think, right-sizing people's isolation periods. I think we need a little bit more science and data on this, but eventually I do think that people are going to be able to go about COVID-19 the way they do with other respiratory viruses. And if they're sick, they stay home. If they're not, they don't. And we'll use masks strategically in that situation as well.
It does seem, however, Dr. Adalja, that there are some lingering effects of COVID that are different than what we've seen in other types of common colds. How does the healthcare system deal with this? And is this going to be a significant strain that perhaps is being underplayed?
We first have to understand a lot more about these lingering effects, because everything is sort of getting grouped into that category. And I think we need a lot more science to actually understand what is true and related to COVID-19, what isn't, and then we can try and understand why this happens. But what we're seeing is healthcare systems are trying to meet this demand. They're setting up long-haul COVID clinics. They're setting up trial registries to try and understand and study these individuals and see how their symptoms change over time, what may help them, what doesn't help them. All of that's going to be part of the post-pandemic phase, is dealing with whatever proportion of people are left with long COVID. But one thing is certain, is if you're vaccinated, you're much less likely to get long COVID. So this is something that came from the first wave of infection before vaccines, and now is happening because people are not vaccinated.
Mr. Adalja, Doctor, thank you so much, of Johns Hopkins Center for Health Security. You brought up China, Tom. Some really interesting comments coming from George Soros. I'll read them out verbatim.
Please.
Remarks prepared for delivery at an event sponsored by the Hoover Institute at Stanford University said the following, quote, "Given the strong opposition within the Communist Party, Xi Jinping's carefully choreographed elevation to the level of Mao Zedong and Deng Xiaoping may never occur." He blamed it on a whole range of things, Tom. Enemies within the party, a real estate crisis, ineffective vaccines, and a falling birth rate as factors going against the leader in China.
The risk here, John, is it will be taken as a 91-year-old liberal speaking at the conservative Hoover Institute, talking, as he can talk. And, the people for and against Soros have said that for years. Unfortunately, there's a theoretical foundation here which centers off the wonderful work of Elizabeth Economy at the Council on Foreign Relations. She's been out front for over 3 years on questioning the might of President Xi.
Lisa, there are some pretty strong words from George Soros.
It's coming at a time where you have to imagine that people are not particularly pleased at additional lockdowns and other types of measures in order to reduce the spread of COVID when the rest of the world is starting to treat it as endemic. How does this nation deal with the fact that before and after the Olympics, there are going to be all sorts of curbs on public activity that are probably going to reduce growth? You're already seeing those downgrades in terms of growth expectations. How does he come out of that looking strong?
Will you watch the Olympics? That's what I want to know.
Me?
You're going to watch the Olympics?
This is a loaded question. I think that probably parts of it, but are you going to boycott them?
Why do you think it's a loaded question out of interest?
Because I think that you think that there's a question of why more athletes have not boycotted, or why there is this issue, why the International Olympics Committee has been so quiet about some of the controversial aspects of hosting it in China.
Getting into the business of what people think is a dangerous one, Lisa. I think it's good that you've brought up those issues, though. They're important questions that we should discuss through the week going into Friday.
Today. You're drinking Tang?
I'm joking. We're so on the same page on all of this. Tom, many other people are very, very surprised that these Winter Olympics are even happening for a whole range of issues.
I agree. I mean, it's there. I noticed on YouTube yesterday, there's a whole NBC thing where they've got delayed thing where you can watch it without being surprised or whatever. Good luck with that. John, in our world, I want to segue here to something really, really important, which frankly was buried. The German 2-year yield has gone out to new highs, I believe back to 2016. The Germany 2-year yield, John, doing that is a huge deal.
I was saving that for later, Tom. Trading inside the interest rate, the depot rate, the ECB for the first time since 2015.
I have no idea what you just said.
We're going to talk about it in about 35 minutes, Lisa.
Well, good, I'm glad. It's actually interesting. Japanese yields also
I can see you through the window.
That works, Tom.
Okay, thank you.
We'll communicate a little bit more effectively.
Yes, thank you.
Tom Keane, Lisa on the Olympics. I'm Jonathan Ferro. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Hopefully, the Fed gets this right. I think the chance of that is fairly low.
The Fed is in a very tight spot.
It's really going to be the data that's in the driver's seat.
People are going to get a little bit nervous about strong data because obviously the big fear is the Fed's going to be more aggressive.
Even with 4 to 5 rate hikes, the economy and strong earnings should be able to shine through.
This is Bloomberg Surveillance with Tom Keane, Jonathan Ferro, and Lisa Abramowitz.
Hello, February, from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Brabitz. I'm Jonathan Ferro. Your equity market down 0.25% on the S&P. TK leaving behind an ugly January.
Ugly January, really interesting. I mean, step away from it. When you're in triple leveraged all cash, John, you can do that. You can step away from the carnage that we've seen. I'm sorry, the recovery the last couple of days was pretty good, John. NASDAQ, and it was the way the NASDAQ took the rebound, not even halfway back. I understand there was real carnage, but I'm sorry. The VIX here this morning, John, 25.02. We're at 32 a cup of coffee ago.
That drawdown last month could have been so much worse without the biggest two-day pop on the NASDAQ going back to November 2020. That was the move to close out the month. Tom, you are still laser focused on the earnings. UPS front and center this morning.
UPS front and center, I think it's just huge. If anything, is bigger than the Microsoft announcement the other day. Apple doing well, as we've got the others coming up. I guess Amazon's a big deal on Thursday. But FedEx and UPS, John, they're the backbone of the nation. Everyone looks at them. It's maybe like John Deere was 40 years ago. It's everybody's focused on logistics, and it's a bang-up set of announcements from UPS.
UPS at a pre-market up almost 7% now. What's later, Lisa? Alphabet after the close.
Yeah, we get Alphabet after the close. We've got tomorrow Facebook, and then, of course, Thursday, we've got Amazon. I just keep thinking, though, rarefied air, that is where we're at. How good do earnings have to be to justify valuations, especially if you start factoring in higher benchmark yields? How much of a reprieve did the NASDAQ get from the decline that we saw in longer-term yields over the past couple of days, John?
And on the yields on the Fed, Lisa Hornby of Schroders in that opening segment as we open up this hour. Hopefully the Fed gets this right. The chances of that are fairly low.
Yeah.
What is a soft landing? What is a soft landing?
A soft landing is the economy returns to a more sustainable pace of inflation and growth. 3% inflation, 2.5% inflation, 2.5% yields maybe. The chances of orchestrating that without some sort of big downturn is what a lot of people are very concerned about.
Equities this morning, negative 0.33% on the S&P. Let's whip through it. On the NASDAQ, we're down 32. We're down 0.2%. Tons to get through this morning. Yields in 3 basis points on 10s, off the highs of the year, actually well off the highs of the year on 10s, and on 2s we pull back as well. In the FX market, euro firmer, euro dollar firmer by 0.33%, 112.72 going into the ECB on Thursday, and Lisa crude backing off just a bit, down 0.5% at 87.77.
Yeah, but still we're looking at some of the highest levels for oil prices going back to 2014, and how does that factor in to the inflationary backdrop the Fed officials are grappling with? Today, in about 90 minutes, we speak with Philadelphia Fed President Patrick Harker. He is joining us here on Bloomberg Surveillance, along with, of course, Michael McKee. I really am curious at how they are looking, these Fed officials, at the flattening yield curve. We have heard that this is maybe not necessarily as predictive of a downturn as it has been in the past. That's what Fed Chair Jay Powell said, that basically this is a muddied indicator. However, a lot of people are thinking otherwise as we see the flattest yield curve going back to late 2020. At 10 a.m., a slew of economic data, including the job openings information from the month of December. How much does this show the decline in openings as a result of Omicron? How do we start factoring that in as a temporary blip in a year of temporary blips, whether it's inflation or whether it's virus upsurges? And of course, we're also going to be getting ISM manufacturing PMIs for the month of January. Again, how much do we see that decline as a result of Omicron? And how much does this indicate perhaps a bit of a slowdown after the huge surge in physical goods that people bought last year? And aftermarket, we were talking about this, Alphabet reporting earnings. They are down a little bit more than 6% year to date. You've seen a similar drawdown for Facebook, down 6.9%. They report tomorrow. Amazon reporting Thursday, down more than 10%. They are the standard for what happens when people are demanding more in wages. How much is wage pressure going to be a key issue for this earnings season, and frankly, for some of the more people-intensive tech companies?
Without a doubt, Lisa, I'm pleased you brought that out. Last year, that stood out for me. That stock did nothing.
Yeah, and basically this year the question is, how do they gain that momentum at a time when those wage pressures are only accelerating?
Looking forward to the earnings coming out through the week. Tom, the earnings coming out through this morning, a boost to the dividend at UPS, a cut to the dividend, AT&T. What do you see?
Dividends, AT&T is a really nuanced story here with the Warner Discovery transaction. They give some color to it this morning. But, John, on a cash basis, and people don't do this enough, you look at the cash amount of dividend paid. AT&T now at $15 billion. People were modeling $9 billion. They say no. After this transaction, they will be at $8 billion. And, again, dividends matter. John, this is the distinction between dividends and share buybacks. Dividends are like gospel. They're like a really serious thing, and boards have trepidation in lowering the dividend. Telephone dealing with that right now.
I've seen that in London repeatedly, Tom, over the years.
Yes,
as well.
I agree. Yes.
Down 5% of the pre-market on AT&T. Joining us now, Troy Gajewski, Chief Market Strategist at FS Investments. Troy, here's your line. It's an open question as to whether we topped in late December or will make one last move higher in Q1. It's looking doubtful. Troy, why is it looking doubtful?
Well, yeah, I mean, I think so far this year, the good news is that markets have been aggressively repricing future tighter money supply and tighter Fed policy. But the bad news is that, the Fed hasn't really even done anything yet. I mean, they've only reduced their bond purchases from $120 billion to $100 billion in January, which is still a pretty epic level of liquidity injection. And yet here we are fighting multiple compression. So when you think about all the technical damage that was done and the fact that investors across the board are really ratcheting up the potential and the probability and the magnitude of Fed hikes, and right behind that you have balance sheet drainage, it just looks like blasting through the highs in late December or early December for the NASDAQ is a much lower probability proposition than if you asked me the first week of January.
Troy, I can't not ask you this. You've been such a big proponent of Bitcoin as a hedge against some of the inflation. We have seen it absolutely destroyed this year. How are you thinking around that, given your allocation?
Yeah, well, so look, I mean, when you think of crypto in general or Bitcoin, it's really a hedge against government profligacy as opposed to day-to-day or week-to-week mark-to-market price action. And clearly, when you think of the environment today versus 6 months ago or 12 months ago, just like every other asset, as money supply growth slows, you have less upside and more downside. And furthermore, in Bitcoin in particular, you're fairly late in the halving cycle. So those are the two negatives in the short to medium term. And then on the positive side of the ledger, you still have continued adoption. So just like equity markets are going to be a push and pull between a stronger economy, stronger earnings, and multiple compression, in the crypto space, it's going to be a push and pull between, late in the halving cycle, slower money supply growth, and gradual adoption, not only in the U.S., but globally. But clearly, this year will be much choppier and rougher for crypto than last year or the year before. There's no doubt about it.
Troy, you mentioned this year, and you make an allusion back to 2018 as well.
Yeah.
And what was the struggle of 2018 is how few did well. And the answer here, it's about profitability. Explain the power of profitability this year.
Yeah, so look, if you look back to 2018, the reason we use that as our base case for 2022 is that, very similar environment. You didn't have the inflationary pressure, of course, at that time, but you had relatively robust economic growth, and you had 22% earnings growth that year, obviously driven in part by tax reform. So very strong year for the economy, for corporate fundamentals, yet 90% of investable assets were down. Why? Because the Fed was not only hiking rates, but also draining their balance sheet. You fast forward to today, we actually should get better economic growth, somewhere around 10% plus or minus earnings growth with a little bit of upside surprise to that. Yet, here we go again, multiple compression that's tied to higher rates and also the potential for more aggressive balance sheet tightening or reduction. And so, when you look at history of markets, most years you end up with better market outcomes than economic outcomes. And in the years where you have much worse market outcomes versus economic and earnings outcomes, that's really driven by the Fed tightening, whether it's 1994, you go back to when 2017 or particularly 2018, that's always the explanatory variable. So look, you look back at 18, equities are down 4 and change. Most assets lost several percent. It wasn't a disaster, and that's kind of our base case for this year, where it'll be a gradual bleed in multiples that's offset by stronger economic fundamentals. But fortunately, the risk of recession is exceedingly low, and 4 or 5 Fed hikes is really not going to change the trajectory of the economy meaningfully.
Troy, always wonderful to catch up with you, mate. Thanks for coming on today. Troy Gajewski, great to see you, of FS Investments. We've all seen those charts. Lisa, you've seen those charts of the forecast for the 10-year yield, 12 months out, and then the actual 10-year yield gets nowhere near it. Have you seen those
Yeah.
charts for the Fed funds rate as well?
Yep.
Coming out of the crisis, the lines are somewhere up there, and the actual Fed funds rate is really, really shallow and just dives underneath with no problem at all. We've been conditioned by that. So every single day, just out on Twitter, just gauging what people think about things, you put out those forecasts for the Federal Reserve rate hikes this year, from Bank of America at 7, all the way down to, say, Morgan Stanley at 4, Barclays at 3. You just get this series of replies. Yeah, right. Try 0. Right. Try 1. No chance. We've been so conditioned by the last 10 years that the Fed underdelivers. It does not overdeliver. That's where surprises can come from.
I could not agree more. And some people are saying, wait for the real reaction in equities when you actually start to see the action and not just the talk, because you still have the likes of Peter Scheer saying, look, they're just jawboning the market. And if that's the case, you know, if they follow through, it could be the sort of a catalyst for something more significant.
I heard from Greg Staples yesterday, Tom, he doesn't buy the shift either. He called them plastic talons. Said Chairman Powell's not a hawk at all. Does not buy the shift.
To the theory that you and Lisa were talking about, I just flat out don't agree. I think there was a natural disaster called a pandemic. And maybe in honor of Bill Dudley, I'll say there's a center tendency to higher inflation. But all the surprise here could be to the downside if and only when goods inflation rolls over and normalizes.
Futures down 0.2%. We'll continue this conversation. NASDAQ futures down about
on
a tenth
the break
of 1%.
where they can't hear us.
Yields in 3 basis points at 174.30 on 10s from New York City. For our audience worldwide on TV and radio, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. More high-level talks on Ukraine set for today. U.S. Secretary of State Antony Blinken will speak by phone with his Russian counterpart, Sergei Lavrov. Russia said it has yet to respond to written proposals on how to de-escalate tensions. Meanwhile, the U.S. and the U.K. are preparing economic sanctions for Russian elites and their family members if Moscow invades Ukraine. Kim Jong-un has now blasted his way onto President Biden's foreign policy agenda. In January, North Korea's leader conducted more missile tests than he did in all of last year. That's seen as a signal that Kim is preparing to fire a long-range missile that could reach across the U.S. North Korea wants the U.S. to lift sanctions, whilst the U.S. wants an end to North Korea's nuclear program. Federal Reserve officials are showing little stomach for an aggressive 50 basis point interest rate hike next month. They say they want to avoid unnecessarily disrupting the U.S. economy. 4 of them made remarks on Monday. Kansas City Fed President Esther George said, quote, "You always want to go gradually in this economy." Blackstone and Carlyle are in talks about teaming up for what could be one of the biggest buyout deals ever. Bloomberg's learned that private equity firms are considering a bid for the generics unit at Swiss drug maker Novartis. It could be valued at around $25 billion. And UPS benefited from higher prices and rising holiday deliveries to post profit that beat estimates. The package carrier also came out with an outlook for this year that was better than expected, and UPS boosted its quarterly dividend by 49%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Earnings season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
NASDAQ 100 on pace for its worst month since March 2020.
Bloomberg breaks the numbers first.
Netflix, of course, is the stock of the hour.
A pretty big miss.
This is a mighty crash.
An expert analysis you won't get anywhere else.
The banks is potentially a bad bellwether.
Not only you're not getting incremental earnings growth, you're getting reduction in earnings growth.
What to buy and what to run away from.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We're living in very interesting, unique times. This is unlike anything that any White House has ever experienced before. Well, maybe 100 years ago. So we're going to continue to follow the president as he continues to put plans out there to move our economy forward and moving people forward.
Marty Walsh there, the U.S. Labour Secretary, speaking to Bloomberg ahead of payrolls this Friday from New York City with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market is softer, lighter, lower, negative, a third of 1% on the S&P. Yields in 3 basis points on 10s, 174.30 on euro dollar, positive there, up a third of 1%. Yields on bonds higher too. We'll talk about that in about 12 minutes. Euro dollar back with a 112 handle, 112.68. Just looking at the range of estimates coming through for Friday, the range is pretty wide. Let's be clear about that. 250 the high end, negative 400K at the low end. 150,000 is the median estimate. And just working through some of the estimates out there, Nomura pops out looking for negative 50K this Friday, but still calling for a chunky move in March, Tom, from the Federal Reserve of about 50 basis points.
Yeah,
so there you go. For a lot of people, this does not make a difference.
It's original, John. I don't have any brilliance here other than, I got the Omicron thing on the jobs report and all. And I believe we have Bill Dudley scheduled to come on later, which will be really important. John, can I just mention your good friend Marty Walsh, the former mayor of Boston? I ran into the Secretary of Labor the other day, and we had a private conversation. And folks, I have to keep this private. He swore me to secrecy. But the former mayor of Boston, John, was heated about Roger Clemens and Mr. Ortiz in the Hall of Fame. We're going to have to leave it there. But this is a guy attuned to the people of New England, besides working at the Department
Tom, just to be
of
clear,
Labor.
did you talk about the labour market at all, or was
No,
the
we
focus of
didn't.
this conversation
No,
on baseball?
I talked to the gentleman
on
from
baseball.
Dorchester about Ortiz and a guy that pitched momentarily for the New York Yankees.
Did you get any thoughts whatsoever at maybe making a run to be the governor?
No, I didn't get it. Who cares?
No one cares about
Nobody
that.
cares
Just straight to the Red
about
Sox.
that. Yeah, well, it was good. It was good to see Mr. Washington. Of course, we always treasure his comments with John Farrell after the jobs report. Maybe we'll see that on Friday. Emily Wilkins with us right now on Bloomberg Government. And of course, the jobs report is not front and center. Wrapped around it is the jobs of the politicians. Emily, give us the political angst right now as people return. What's the new sweat of Democrats and Republicans in Washington?
So for Democrats, this week is going to be all about that U.S. competitiveness bill that has a number of provisions that directly target China and Beijing. For the moderate Democrats who I've talked to, this is a huge relief. They're facing tough elections in 2022. They need something concrete to take back to voters to show they've done beyond the infrastructure that passed last year. And this is a way they feel they can get back on track. It's not Joe Biden's Build Back Better. It doesn't have some of those social policies in it, but it is a way that they can say they're addressing concerns about the supply chain, potentially inflation, showing that the U.S. is strong on international issues. And the question, of course, is we know the House is on track to pass this legislation this week. From there, they're going to have to meet up with their Senate colleagues and get together, try and figure out a path forward on the two different bills that have been passed. And I think that's sort of the big question. Are you going to see them come to an agreement? Are Republicans going to let Democrats give a win to President Biden?
We do this differently than others. John Farrell's made very clear the British model's superior. When they meet, what is it actually like? They go into a room, House and Senate leadership, and argue to compromise on the two bills. How does it actually work?
Well, usually lawmakers are selected. It depends. You want people who know the issues, who have been working on the legislation. And yes, they get together, their staffs get together. It's a lot like other negotiations on legislation where you've got different people in different rooms hashing through things, ordering pizza and takeout when it gets late. No reporter likes to see that. That means it's going to be a long night. But yes, that's something they want to get done. And it's not a formal deadline, but one thing to keep in mind is March 1st, the date that Biden will be going to Congress to give that State of the Union address. Progressives have said they want movement on the Build Back Better plan by then. That doesn't look likely, but certainly Democrats want to give Biden something to tout when he has this national address.
Emily, the backdrop is complicated for President Biden. John was talking about the wide range of jobs estimates for this Friday, and this could potentially be the first negative print of President Biden's entire term. How did the Democrats frame this at a time when they both want to pass this legislation, but also want to tout the economy that continues to strengthen?
You know, it's interesting, Lisa. I think about sort of how the Democrats have been talking about things such as inflation. They've been acknowledging that it's an issue, but at the same point, they'll say, hey, this shows that Americans are still struggling and that we, the government, still have a role to play in helping them through the pandemic. And so, you know, Washington, everyone knows how to spin in this town. I'm sure we're going to see it spun in a way that benefits the president agenda if you're a Democrat, and against that if you're a Republican. But I think at this point, it is interesting to note that at least in regards of jobs numbers and where unemployment stands, those have been things that Democrats have really hung on to as potential bright spots and said, look, you know, things that Biden is doing are working out, even while we do see inflation continue to be high and continue to see supply chain backlogs.
Emily, thank you. Emily Wilkins down in Washington, head of payrolls, and on Russia too. David Rosenberg out on Twitter. This one's timely. The chairman repeatedly went back to 2015 in the last news conference and said the last time we started a rate hiking cycle, the economy wasn't as strong. The economy is stronger now than it was then on several fronts, several issues as well. Inflation's higher. This is what David has to say, Tom. This claim from the Fed on how great the economy is doing compared to late 2015, in his words, is nutty. What would things look like today absent an 11% deficit to GDP ratio? It was 2.8% back then, and a $9 trillion Fed balance sheet, twice the size back then. Tom, that's the claim coming from David Rosenberg.
Well, this is the other side of the coin. And, you know, it's good that you bring it up, John, because we're going to, I believe, again, have Bill Dudley on, who's clearly in a different position than Mr. Rosenberg. Oh, Dudley, we do not have today. Thank you for telling me that, Amy. John, we don't have Dudley today, but what's important here is you've got two sides of the argument, and we're going to bring that to you through the entire week. Blanchflower, Rosenberg, others. You know what? They don't buy it.
I can tell you we'll have a Fed speaker at 8:30, Tom. We'll catch up with the president of the
I don't know
Fed.
who's he with. Dudley
Patrick
or Harker's going to tell us. Dudley or Rosenberg, I don't know who he's with.
And we've got to ask him, Lisa, how useful the payrolls report will be for him on Friday. How useful will it be when so many people are just choosing to look right through it?
Yeah, and frankly, when inflation is their primary mandate right now, I mean, how much do you hear them talking about needing to improve the labor market? It sounds like they are buying into the story that it's a very heated labor market. I do find it interesting, though, just going back to the David Rosenberg place, if you go around and you talk to everybody, do they feel like they're in a better place now than they were in 2015?
Consumer sentiment, I think, speaks loudly on that front. You don't need my opinion. My favorite Tom Keene line of the morning, I'm not going to share what he told me. It was a private conversation, but this is what he said. There's a reason that years ago Matt Winkler tried to ban the word "but"
it was for
in the Bloomberg Star. It's for stuff like that.
It was because of me.
I won't tell you what he told me, but this is what he said.
This is sensitive, John. You don't. It's lost in translation.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Leaving behind the worst month for the S&P 500, going all the way back to spring 2020. That bad, down 5%. Could have been worse. For the NASDAQ, we just had the biggest two-day pop on the NASDAQ 100 going back to November 2020. The follow-through today, just a little bit positive as we kick off the month of February, up 0.1% on the NASDAQ 100. Trimming the losses on the S&P, we're negative there by 0.14% on the S&P. The surprise for me and others, the banks barely eked out a gain, even with that big move in the bond market. So let's talk about that big move in the bond market. 2s, 10s and 30s. 2-year yields get your attention up more than 40 basis points year to date. They back away from that 120 level though. We'll discuss that a little bit more in just a couple of moments time. 114.12. The curve though, and the evolution of the curve got my attention. I'm sure it got yours through the month of January. Closed out 2021 at 77 basis points. Popped through 90 as we got some steepening early in the month. Then the flattener came through, sub 60. Just like that. 2-year yield took over, Tom. Started to bake in more rate hikes, started to think about the prospect that could hurt growth down the road with Goldman out with that GDP cut, Tom. And you do wonder how many other banks on Wall Street follow their act.
I think you're dead on, John. There's going to be recalibration here in February on all fronts: equities, bonds, currencies, commodities, and sell-side economics has to adjust.
A move at the front end, we adjust there in a big way in the Treasury market in Europe too. So let's talk about Germany. Switch up the board and look at this one. What's important about this? That line in the sand, negative 50 basis points at the front end of the German curve. What's important about trading just above that level, so coming into about negative 49? That's the first time we've traded inside of the depot rate of the ECB since 2015. The first time really since QE really kicked off at the European Central Bank. It has been a long time. So what are we thinking about? What are we talking about in markets at the moment? The bar's up here for the Federal Reserve, 5, 6, 7 rate hikes maybe. Where's the bar for the ECB? A conversation perhaps they deliver one at the back end of this year. So where's the scope for surprise, Tom? And what does it mean for the FX market in the back half of this year? That's what we're wrestling with in foreign exchange as the euro pops back, Tom, to a 112 handle.
And again, across the Atlantic, people are going to adjust. They're going to adjust in Europe, John. And I would point out, as we see this morning with Exxon, we'll talk about in a moment, and with UPS, frankly, with T in their transaction, people are adjusting in real time. How does Europe adjust to that inflation? How does Christine Lagarde adjust?
Over to you, President Lagarde. The ECB meeting this Thursday alongside the Bank of England. Thursday, an interesting one. Euro dollar right now, 112.68, positive, about 1/3 of 1%. That's the cross-asset price action. Let's get you some single names and say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Keeping an eye on earnings. ExxonMobil crossing the wire right now, 205 EPS on an adjusted basis, $85 billion in revenue. That's a beat on both the top and bottom line numbers. We're talking about their best quarter that they've had going back in about 8 years, but baked into all this is a little bit of caution here. They're actually saying that you could see some hold up with regards to diesel demand, gasoline demand. It says jet fuel demand could track a little bit lower than what they had previously anticipated. And there are a lot of cost cuts baked in this report. I haven't had time to go through them all, but of course we did get that report yesterday about them moving one of their offices out of Houston to another location in Texas. They also talk about a reorganization of some units here. So keep an eye on ExxonMobil. Those shares slightly higher here on the day by about 1% here in the pre-market. We had UPS earnings a little bit earlier, shares higher by about 7%. Cost issues, a big deal there at UPS. They had to pay a lot more to bring those people in. The good news is they were able to raise prices to offset some of that. And AT&T finally providing the details of that spinoff of Warner Media here. Shares down about 3.5%, partly because that dividend's going to go down pretty significantly. Flip up the board, keep an eye on a few other things. A soft recall over at Tesla. This has to do with the rolling stop feature. This is going to be basically an over-the-air type of recall on the software itself. The shares higher by about 0.3%. And after the bell time, we got a whole slew of earnings that we're going to be keeping an eye on, including AMD, Starbucks, both shares higher here in the pre-market. Also getting PayPal, General Motors, and a few others after the bell tonight, Tom.
Tuesday, Wednesday, Thursday, I watch the close in the afternoon. Lots of good earnings analysis as well. Right now in fixed income, and again, the VIX under 25 to 24.78, a constructive beginning to the equity markets. We look at bonds as well. Ian Lingen with us, head of U.S. rate strategy. Ian, how was your January? Did you survive it? Did you get out from under the desk on January?
Well, Tom, I think that's a fair assessment. I did spend a fair amount of time under the desk in the month of January. Part of it was the massive repricing that occurred in the very front end of the curve as we all really recalibrated to a Fed that has truly delivered on a hawkish pivot. And frankly, this is one of those moments where there's so much uncertainty that we don't even know what we don't know in terms of what the Fed is going to be looking at come the middle of this year. A lot of moving parts right now.
And look at the equity market. We parse bull and bear market. In the bond market, are you preparing for a bond bear market, which is price down, yield up?
I'll argue the opposite. We just got a full pricing in of what I'll characterize as a relatively pedestrian hiking cycle. 4 or 5 hikes this year, few more next year, balance sheet runoff. And look at 10-year yields. We're not at 250. We're hovering around 175. All the action is playing out in 2s, 3s, and 5s. So I think that the moment for a truly bear market in treasuries, particularly 10s and 30s, has passed because, as has been pointed out, the market is worried about what happens if the Fed goes too quickly. Are we going to see GDP figures revised lower, expectations lower throughout the course of this year? That follows pretty intuitively, given what the Fed is doing.
Ian, how much does the flattening of the yield curve really derive directly from the fact that the Fed really hasn't outlined their balance sheet reduction plan? And when they start to do that, you'll start to see longer-term rates move up, as some people, the likes of Bill Dudley in a column this morning, expects to happen.
So I would say that this notion of a pedestrian tightening cycle that I outlined involves balance sheet runoff organically that doesn't include outright selling out of SOMA into the Treasury market. That would be a surprise factor. We don't think that's going to happen, but in the event that that does occur, that's where you get 10 and 30-year yields materially higher, at least on the initial announcement. The other way that we get there is if we get more inflation in the system than we're already expecting, and we're met with a Fed that isn't as responsive as it has been. If we get higher than expected inflation over the course of the next 3 or 4 months, and the Fed ratchets up rate hike guidance, so we get to 6, 7, 8 this year, I think that's where you get a more massive flattener. But if the Fed says, okay, 4 is going to be enough, and we get more inflation, then there's a case for a bear steepener in 10s and 30s.
Let's take this a step further, Ian. You've got the likes of Bank of America expecting 7 rate hikes this year. Would that invert the yield curve?
If we got to the point where the Fed delivered 7 rate hikes in 2023, 10-year yields are not going to keep pace with that. In fact, we're already starting to see break-evens compress. We're already starting to see 5s, 30s as flat as 42 basis points. We should get to flat or inverted over the course of that process. And that begs the question of if the Fed would stop because of that.
Ian, part of the Lingen Nerd Fest is you do the math and you do all the fancy bond stuff, but you're also a student of the history of this. How does any central bank raise rates into a slowing economy?
Well, they're supposed to do it very gradually because what they're attempting to do is they're attempting to engineer a soft landing. But if we think historically, central banks have a very bad track record of doing that effectively. What makes this particular cycle different somewhat is that we've already seen a lot of realized inflation in the system. The market is trading off of very typical late cycle dynamics. And for the Fed to hike us to the point that it shortens the recovery, it's not a policy error, it's a policy trade-off because the Fed wants to hold on to its credibility as an inflation fighter. I think that's going to be this year's story.
Ian, that language is so important. Thank you. Ian Lingen there of BMO Capital Markets. Not a policy error, Lisa, a policy trade-off for this Federal Reserve in 22.
They have to slow growth if they want to get inflation under control. How much is too much, and how much is the yield curve really indicative of what's going on? Honestly, that's kind of shocking. Ian Lingen saying that if they go 7 times, which is what Bank of America is saying as their base case, it would definitely invert the yield curve. And would they care? Standard Chartered are basically there on the yield curve. We think the 2s, 10s curve could be completely flat by mid-year.
and potentially inverted, Tom, by year end, the work of Steve Englander and the team.
Yeah, and I want to make clear here, Standard Charter with a reputation, as we talked to Bill Winters recently, of, third emerging market, frontier economy, Southeast Asia, baloney. Their intellectual staff, John, led by Mr. Englander, is first-rate global Wall Street.
Here's the line, Lisa. We think the long end will draw comfort from any evidence that inflation has peaked and increasingly question the resilience of the growth outlook. We've quickly transitioned here, haven't we? Inflation, next year growth's going to be great. I've gone through the median estimate repeatedly. It's very close to 4. And then people start to question growth off the back of the policy response of the Federal Reserve responding to that high inflation. Goldman first. Who's going to follow?
And there's also this question of how much policymakers will actually move away from supporting the markets and looking at real yields going back deeper into the negative territory as people take a look and say, well, that demand is just going to intensify if you start to get growth concerns. So how do we get out of this to positive real rates like many people are expecting in some of their more bearish calls on the S&P?
Some companies are doing okay. One of those companies, Exxon, sees wider margins with break-evens at $41 a barrel. So just think about the break-even of 41 and the price on a screen right now, just south of 88. Tom Keene, Exxon, the biggest profit since 2014.
Yeah, I have real trouble with this. Exxon for years, a financial company that happened to do oil. I'm not an oil expert on this. I'll leave it to Javier Blas, Will Kennedy, and our world-class team. John, they're moving from Dallas to Houston, which is culturally stunning, to save $6 billion. They've got a 10-year annual return of under 3% per year. Yeah, it's been great, but boy, are they in a catch-up mode.
The stock is up 2%. This morning in the pre-market is up 24% and some year to date in just a month. What a move off the back of what's happened with crude. Energy equities, where the outperformance was in a massive way on the S&P. Your S&P down 0.1%, leaving behind the biggest monthly drop going back to March 2020, down 5% on the year. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In the UK, Prime Minister Boris Johnson is again under fire from members of his own Conservative Party. A report into partying in Downing Street during lockdown slammed failures of leadership at the top of Johnson's government. Johnson promised Conservatives he will get back on track, but many of them are not convinced he can turn things around. Meanwhile, police are still conducting their own investigation. The Winter Olympics in China may be more of a drag on Beijing's regional economy than a boost. COVID flare-ups and pollution curbs are weighing on consumer and industrial activity. A ban on public spectators means there won't be the usual bump up in tourism the city hopes to gain from hosting the Games. The Olympics begin on Friday. The CEO of UBS says that geopolitics is the bigger fear for him and not inflation. Ralph Hamer spoke with Bloomberg after the Swiss bank reported better than expected earnings and it gave an upbeat outlook.
Everybody's making their own analysis if it comes to inflation there. But you can work with that. Geopolitical tension and the potential events coming from it, that's more difficult.
Meanwhile, UBS pledged to buy back about $5 billion of shares this year. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
When you have companies like Apple, and you can pick any other name within that large cap tech universe, they've come under pressure, but maybe for the wrong reason. Because these are not companies where you're looking at discounting cash flow in 10 years. As we saw last week, they're generating tremendous cash flow in real time.
Fantastic lineup of guests this week going into Payrolls Friday. That was Russ Kostrick of BlackRock. From New York City, alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Your equity market positive on the NASDAQ, negative on the S&P, negative on both for the year so far. We are down 0.1% on the NASDAQ 100, on the S&P, down 0.1% rather on the NASDAQ, up a little more than 1/10. Yields in 3 basis points on 10s to 174.65. This just in, the artwork that comes from some of these audience members is just remarkable, Lisa. Brilliant. TK nails it again. Stock market traders down 3%, crypto traders down 40%, and there he is, looking comfortable. I think that's a Davos shot from about, I don't know, Tom, 2005.
He was still
triple leveraged, all cash, sitting pretty and happy.
That hat is history. Ken O'Fee ate that hat about a year and a half ago, I think, chewed it up to shreds. We all know the triple leverage cash fund's a joke, and it has to go back to enhanced bond products, John, of 20 years ago. But as we had Ben Laidler on, interesting, I think it's important to understand taking a 1-month perspective is hazardous to your health.
He thinks that the valuations, Tom, as high as they are in some places, he thinks it's justified because profitability has been that good and the runway for growth is decent as well. In his mind, for some of these big names.
Yeah, I've been waiting through Jim Suva's 20, 30 pages on Apple Computer rewrite, where he lifts up to a $200 price target. And again, it's that perspective, folks, of someone like Jim Suva, or for that matter, Ben Laidler, going out 3 years, 4 years, 5 years. Kriti Gupta knows that the perspective on Alphabet is simple. Google, it's not Alphabet, Kriti, is up 24% per year for the last X number of years, and the free cash flow growth is an act of God. What do you got today?
Yeah, well, it's a really big piece of the equation. Two things you got to keep in mind ahead of the earnings after the bell: cash and cloud. And we really want to talk about just the earnings picture when it comes to that, which brings me to my chart of the day. On a logarithmic scale, we looked at the revenue of Alphabet, Google, if you will, and just look at the regression there on a 10-year basis. It is a straight line up. And this is really interesting. And here's why this is significant. Plenty of companies make money. Plenty of tech companies have a chart that looks like this. But Alphabet, or Google, if you will, actually has a far more cyclical exposure relative to the other tech names. They're far more dependent on business spending, on ad spending, and now add in the cloud picture, the idea that this technology has been around for ages, but they're just now, corporations are just now adopting it from a wider perspective, simply because of the kind of work from home era. And that's eating into, or I should say playing into, Alphabet's bottom line.
The Bloomberg Intelligence summary of quote unquote the cloud, which, full disclosure, folks, I still don't understand, is there's tons of growth available. That the cloud is in, I don't know if they're in the second inning or the fourth inning, but they're in something early in the game. What does that mean for Amazon, Microsoft, Google, and the rest of them?
Yeah, well, on a percentage basis, on a revenue basis, it doesn't actually make up that much of their revenue. Keyword is yet, because it's going to. And this is, once again, comes back to the idea that this technology, well, it's been around for ages, but no one has been adopting it until recently, until the pandemic, when you start to see a lot of these corporations really invest. So let me just give you some numbers here, throw them at you. Alphabet, about 8% of their revenue comes from their cloud business in particular. Put that into perspective from Amazon, which we're going to be hearing from later in the week. About 14.5% of their revenue comes from cloud. Put that into even more perspective with what we heard from Microsoft last week in their Azure business. That makes about 35% of their total revenue. So once again, it's not making up the majority of their gains, but the idea, and I think Dan Ives over at Wedbush was spot on with this.
He's a bear.
Well, he's saying that this is going to be the focus. I mean, you can talk about cash, you can talk about ad spend, but cloud is really where it's at.
Kriti, I'm looking right now at Microsoft returns, because Microsoft reported incredible earnings, and their shares are down 7.5% year to date. It was not enough to materially claw back some of the losses that we've already seen. The good news has been baked in for so many of the big tech names. How much do we count that in terms of how high the bar is for this earnings report?
Yeah, well, it's a high bar. I think it was a higher bar for Apple and Microsoft because, once again, even in the big tech space, I think we like to group together those big five names, but they're actually pretty different. You have Alphabet, Meta Platforms, formerly known as Facebook, and, of course, Amazon, far more exposed to what's going on with the consumer picture, with the business spend picture, as opposed to Apple and Microsoft, which have far more pricing power, and that's actually something that supported the idea that perhaps those gains are priced in. Nevertheless, to your point, Apple and Microsoft, even with that kind of expectation that they were going to have some pretty strong earnings, coming out even more on top of that and still seeing the stock rally, that's really good news for Apple and Microsoft. Whether that continues on to Alphabet, Amazon, and Meta Platforms is a different story, because Alphabet has actually a history of becoming a leading indicator for that consumer spending picture in the United States. And we all know that consumer spending picture is really what's under threat when you're looking at it from a macro picture.
This all sounds great, and we hear tech analysts talking about fundamentals and cash flow streams, but how much are all Wall Street tech analysts now closet rates traders?
A good chunk of them, and this is going to bring me to my chart of the day, I think of last week, when we were looking at the positive correlation between big tech and, of course, the 10-year yield. And a lot of people actually asked me, why are you seeing this correlation positive when you continue to have big tech continue to rally, but then yields continue to actually drop directionally on a longer-term basis? They're actually diverging. And the reason for that, Lisa, is simply because on an intraday basis, they move together. Tech higher, yields lower, tech lower. But on a longer-term basis, the margin of the move is what's significant, because on the upside, tech tends to have a much larger move to the upside. Take out the last couple of weeks where you've had that selling pressure. But then on the downside, yields tend to move far more when you start to see that bid into Treasury. So because of that dynamic where you start to see tech higher on one side, yields lower on the other side, that's really what's creating that divergence in the long term, whereas intraday, the correlation remains positive.
Cruddy, thank you. Brilliant. Cruddy Gupta there. What are you asking for here, Lisa? For Dan Ives of Wedbush to have his Fed rate hike guesses at the bottom, at the bottom of the release.
Honestly, how much is this what you got to do in terms of what the valuation is? If this is a valuation correction, how much do fundamentals matter?
I ask the question a lot when the single name analysts come on. I mean, come on, given what's happening right now, can we talk about fundamentals exclusively? Can we just talk about what's happening in the rates market? It's where the conversation's gone to, Lisa.
Yeah, and how much does the bar just get higher and higher? I mean, we were talking to Ben Laidler, and he was saying, you know, every 50 base move really amps up the bar in terms of where earnings have to come in. So you have to, I mean, at what point is it an earnings story? At what point is it a Fed story?
Well, let's talk about the fundamentals just for you. AMC Entertainment, prelim fourth quarter revenue, about 1.17 billion. The estimate was 1.09 billion. That's a beat. Fourth quarter prelim net loss comes in at 114.8 to 194.8 million. The estimate 130.1. Keep up with this one, Tom. 18 in the pre-market, up more than 12%.
Claudia Eller over at Variety featured this. I can't remember if it was this week or last week, John. I don't know what the big movie was recently, but is it a return to movies or was that a one-off? That's the heart of the matter.
Return to movies? Honestly, they have to figure out the new experience. That's what my suggestion would be.
That single name is about more than the return to movies, that's for sure. AMC up by 14%.
Reddit? Is that the implication here?
In some ways, sure. And a whole lot more.
Yeah.
Coming up, Alicia Levine of BNY Mellon. And Dan Ives coming up to call that, no, he's not. From New York, this is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The problem with inflation is that it's systemic in ways that is very difficult to fight.
The yield curve is telling us that the amount of space that the Fed has to maneuver is relatively limited.
Given the Fed's positioning right now, it certainly raises the risk that we could see the Fed front load the rate hikes.
They have to address this inflation problem.
Hopefully the Fed does navigate this well and doesn't over-tighten into a slowing economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Earnings season upon us, and a lot of other news as well. John Farrow, I look at where we are. I'm looking at the acclaimed NIERN function. The earnings pour out, and it's corporate America adapting to the cards they were given.
Tom, you nailed it last year. Last year wasn't about the Fed. It was about corporate earnings. It was about margins, resilient margins, and companies that adapted. The start of this year has been about one thing: the Federal Reserve adjusting in a big way at some point in 2022, and many people think that kicks off in March. Luke Carr, UBS, important writing from them, pointing out this is a valuation-centric sell-off to start the year. It is not a growth scare. It's the latter, not the former. Tom, when does it become the former? Goldman Sachs out with their GDP forecast cut in the last 24 hours for the U.S. Things are moving very, very quickly.
Things are moving. Now, that's a real GDP analysis. Let's forget about the inflation story, John. Let's frame it. And I like what Jan Hatzius did. He said it's so a jumble that he's looking at Q4 21 out to Q4 22, and that's a sub 3% statistic.
Well, let's take the annual number, Tom. 3.2% is the annual call for them for 2022 U.S. GDP growth. Consensus at the moment, the median estimate up at 3.8. Does that come in as the year progresses? That's going to be the big call. Does the Federal Reserve move, but move into a weaker economy, an economy, Tom, that's decelerating through the year ahead?
And Lisa Abramowitz, you featured this morning, the idea of the choice set that the Fed has staggering to March. 50 basis points, I mean, is that drifting away?
Look, I think a lot of people really question the reality of a 50 basis point rate hike. In any case, it seems like the likely outcome is a 25 basis point hike in March, but it's after that that really matters. Are they going to go every meeting? Are they going to start balance sheet reduction? And then what economic data point are they going to cling to in their data dependency? Is it going to be the jobs market, or is it just going to be inflation front and center? Or frankly, are they going to look at these earnings like Exxon and say, wow, they did amazingly in terms of their profitability, but the cost cutting is remarkable. How much is that a theme in corporate America?
Let's open it up to both of you. We're going to stop the show right now, folks, and we've got Alicia Levine to give us great perspective on this after the data. Lisa, let me go to you first. I'm sorry, cost cutting, that is the message I'm hearing today.
How much do you try to reduce the head count at a time when the price of each individual employee is going up? How much do you start to see that being a theme as we start to see wage inflation, which is arguably a good thing, and yet the participation rate remaining stubbornly slow?
And John, look at UPS. What a bang-up earnings there. I'm going to suggest, John, UPS turned the market around with now red and green on the screen, NASDAQ up fractionally.
The numbers from them look good. AT&T have their own struggles. We can talk about that later. Lisa nailed it. How sticky is the wage inflation for 2022? If it is, can corporations keep up with it? If they can't, then we've got a problem, haven't we? Because rents are going in one direction at the moment, Tom. So even if these supply chain kinks work themselves out, we work through them through 2022 and things get better on that front, you've still got this push higher in rents that could keep things elevated. Yeah. This could persist. Yes, it can come down from 7, the headline number at the moment. That could be your average for the first quarter. Wells Fargo, Sarah House have pointed that out. Yes, it can decelerate, but it can persist, Tom, above target for longer than people realize if rents remain elevated and they keep kicking higher in the way they have.
Well, shout out to Matt Boesler of Bloomberg Economics writing up the rent story in America. We'll get that out on social media. Probably Lisa's already got it out where I have failed. John, I'm going to mention green on the screen, NASDAQ 100 up fractionally, but that's better than it was 2 hours ago.
Bramo's a machine, Tom. If you've got time to ask her, she's already put it out there on Twitter, okay? Futures down a tenth on the S&P. We're negative about 3 points. On the NASDAQ 100, a bit of a lift, up 30 points. Yes, we had a dreadful month for the month of January on the NASDAQ 100, down around about 8.5%, but it could have been so much worse. We just had the biggest two-day rally on the NASDAQ, Tom, since November 2020. A really strong finish.
That was a nice finish there, and of course across all. And from the bulls, we're hearing that. Mike Wilson goes the other way at Morgan Stanley.
Mike Wilson's right to point out one thing, Tom. The whole team.
Yeah.
Forward guidance is gone. They are not going to hold your hand anymore over at the Federal Reserve. And that's why I think this is getting messy. We've got hikes, calls for 3 over at Barclays, calls for 7 at Bank of America, and a Federal Reserve that, let's be clear, Tom, they don't know. When you hear from the hawks, President Bostic of Atlanta, listen to him. Maybe we go at 50 if we need to. I don't know if we need to. We'll find out in March. I'm penciling in 3. Keyword there, pencil. You can erase that, Tom. It could become whatever they want it to become. We just don't know. And that's going to be a key feature of this year. For some people, that's a bug.
Right. Alicia Levine with us, head of equities capital market advisory at BNY Mellon Wealth Management. Alicia, what do you see in the corporate space that will inform the Fed of the tough decisions they have to make?
Look, the really interesting thing about earnings season so far is that with all the concern about margins and inflationary pressures, actually margins have held up very well in the face of input costs going higher and employee costs going higher. So that's an important thing because that's what the market's focused on, which is the inflation out of control and what will earnings be? Can we project earnings with inflation this high? And the answer so far is yes. And I think that's why you've seen some stabilization in the markets because the fundamentals are actually coming in better than feared 2 and 3 weeks ago. So corporate America is telling you it's still okay. I was shocked to see the margin number in the aggregate and the companies already reported. So that's what's stabilizing here. And the other thing is, let me paint an interesting scenario for you. So we're all concerned about Russia, Ukraine, and oil prices and having $120 oil sort of destabilize markets. Well, what if it's done, right? What if the West says, you know what, we're not going to bring Ukraine into NATO. Putin gets what he wants without, blood and treasure being wasted. And oil all of a sudden has a different kind of price. And if that's the case, then I think the big shock worry to the market is over. And I think that's a very realistic scenario.
I'm just going through your sector breakdown. Some of the style calls, just the thematic calls as well. Buy business capital spending, cautious on the consumer. Buy profitable tech, buy industrials, buy healthcare, buy financials. Where's the energy piece in all this then, Alicia?
So we like energy here. We just think that there's been a huge price shift upwards so far. And with the calls in the market for $120 to even $150 oil price, I think that given the scenario, it may not happen. And we may be close to highs. We're not there yet. There's still upward pressure on oil prices here. But I think much of the move is already done. We like energy, we're strong energy, but if we're talking about adding new capital today, I wouldn't add new capital today simply because the move is over and this expectations for World War III in Europe are probably not going to happen.
Alicia, the scenario that you're portraying isn't that optimistic. The idea that we're going to have lower long-term run rates in terms of yields, that we have the priced-in Fed, that we have oil prices that are going to come back down, and the margin story remaining intact even as you see wage inflation really raging. I wonder how much cost cutting, how much where this really indicates a later cycle type of stage rather than something that is a resurgent economy.
So look, we do think we're mid-cycle here, and as you've been talking about all morning, this is dancing on the head of a pin for the Fed. It's a dynamic economy. It's not linear. These are not linear decisions. But I think the yield curve has told us a lot in the last few weeks, which is as rate expectations go higher for the Fed funds rate and that 2-year moves higher, the 10-year softens. And so we're now in a position where essentially if the Fed moved 50 basis points in March, which is not our base case scenario, you're going to destabilize rates pricing in the market. And that's the last thing the Fed needs to do right now because it limits their hands on the out meetings. So we do think you'll get Fed hikes March, May, and June, and then the Fed will have to reassess where we are in the real economy. I think the Fed's issue here is not so much slowing the economy. Its job is to slow the economy right now because we're frying in oil. It cannot do anything about the supply chain. It can do something about demand. So that is its job right now, to soften the inflation picture, because that's its mandate. And if it fails at the mandate, that's not going to be good for the institution.
Alicia,
so they're
just
going to be
quickly,
looking at inflation. Yeah.
I want to squeeze this in. Where does that leave the banks trade?
So look, we like financials. We prefer the insurance companies here because the insurance companies will do very well. Again, financials have moved strongly. We've seen some of the pricing issues. We think this is the year for be selective. I think it's very difficult to play the sectors. You have to play cash flow. You have to play earnings. And you can't just buy. I think the year of buying an index or buying a sector call is going to be very difficult. You have to buy individual companies here with dividends, cash flow, and earnings power. It's a very complicated year. Yes, we're still bullish. And we do think the Fed cannot go 7 times this year. I just think the yield curve is telling them that.
Alicia Levine of BNY Mellon Wealth Management. Alicia, thank you. That 7 hike call. We've got to catch up with Ethan Harris over at Bank of America, Tom. We've got to catch up with him soon. That is one heck of a call coming out of that team.
We will do that with respect, John. It is so hard to do what our guests are doing, which is gaming the unknowable. And so, yeah, we're going to check with that. I love Bill Dudley's word magnitude. The magnitude of this is a really important economic word. It's drenched in British history, John, to be honest. But the magnitude of these calls is just stunning, the sheer percent move.
I learned a lot from Steve Major a long time ago when I was in London of HSBC. And one thing he said to me, and it stuck with me for forever, which is why I always respect a forecast. He said, John, a forecast by definition cannot be wrong because it is a forecast. So when Ethan Harris comes on of Bank of America, of course he deserves respect. Yeah. No one here's got a crystal ball, TK, on the path ahead.
What I learned from Steve Major is West Ham can make trades when it matters, unlike the Tots.
And Spurs have struggled to do that. That's right. We're going to talk about this Federal Reserve with Patrick Harker, the Philadelphia Fed president. We'll do that at 8:30 Eastern. The man himself, Mike McKee, dropping by to help lead that conversation. Looking forward to it. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. There's a flurry of diplomatic activity today as Western countries try to keep Russia from invading Ukraine. U.S. Secretary of State Antony Blinken will speak by phone with his Russian counterpart. British Prime Minister Boris Johnson and Dutch Prime Minister Mark Rutte will be in Kiev to meet Ukraine's president. Meanwhile, both the U.S. and the U.K. are finalizing a package of potential Russian sanctions. Kim Jong-un has now blasted his way onto President Biden's foreign policy agenda. In January, North Korea's leader conducted more missile tests than he did in all of last year. That's seen as a signal that Kim is preparing to fire a long-range missile that can reach across the U.S. North Korea wants the U.S. to lift sanctions, whilst the U.S. wants an end to North Korea's nuclear program. Federal Reserve officials are showing little stomach for an aggressive 50 basis point interest rate hike next month. They say they want to avoid unnecessarily disrupting the U.S. economy. 4 of them made remarks on Monday. Kansas City Fed President Esther George said, quote, "You always want to go gradually in this economy." And ExxonMobil posted the highest earnings in almost 8 years. Aggressive spending cuts helped the oil giant capitalize on surging energy demand and prices. Exxon shares are up more than 20% this year. That's after an almost 50% gain in 2021. Blackstone and Carlyle are in talks about teaming up for what could be one of the biggest buyout deals ever. Bloomberg's learned the private equity firms are considering a bid for the generics unit at Swiss drug maker Novartis. It could be valued at around $25 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Earnings season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Bloomberg is fastest with the numbers and analysis.
This is a mighty crash.
What to buy and what to run away from.
Bloomberg, the fastest numbers and analysis you trust.
He is not de-escalating. At one point, he had claimed he was de-escalating, that they were moving forces back. That's not the case. That's not what we're seeing. And for that reason, we do have that decision that the U.S. wants to keep those forces on alert. And that's something we can do for quite some time. I don't think any of us are worried about that. But that those troops will be ready should we need them to defend NATO territory.
Gillian Smith, the U.S. NATO ambassador from New York City this morning. Good morning. Tom Keene, Lisa Brabbits and Jonathan Ferro counting you down to an important conversation with President Harker of the Philadelphia Federal Reserve. The equity market up 45, let's call it 44 on the NASDAQ. We're up 1/3 on the S&P, barely positive there after a negative month last month, which by this point you know all about. Yields in 2 or 3 basis points on 10s to 174.83 going into payrolls Friday. The median estimate is 150K. We've just heard from Brian Deese, the National Economic Council Director, out on a U.S. network called MSNBC, Tom, here in the States.
Down that, John.
He's setting us up for a soft print. Well, I don't think many people outside America know what that is, TK. I think he's setting us up for a soft print here. Omicron expected to impact the January job numbers. That's Brian Deese. And Tom, let's be clear. Do they matter this Friday? Given that some of the banks with the biggest Fed rate hike calls for this year are also in the negative camp. Nomura, a negative 50K for this Friday. They think we could get a 50 basis point move in March. Bank of America at negative 150K this Friday. They think we can get 7 hikes this year.
I take your point that it doesn't matter like it did the last time around or maybe the next time around, but the wage inflation component along with the JOLTS survey. Do we get JOLTS today?
Yeah, 10 a.m.
Yeah, thank you, Lisa.
Lisa's got the estimates ready to go.
She's like ready to go. And, I think JOLTS and like the wage data for the unemployment.
What's the number, Lisa?
Report.
It's expected to come down a little bit. I was looking actually at the Indeed.com numbers. The number is actually 1.03 million, or excuse me, 10.3 million job openings, but that's down from nearly 11. So, how much is this a blip and how much is this 0.2? Are really going to want me to keep going? The tightness in the labor market.
We're still listening.
You are?
I don't know.
Is it a tight labor market? It's a tight labor market, a strong labor market.
Well,
There's been some debate about that.
Yeah, a lot of people are saying it's a tight labor market, but it's not a strong labor market because of the lack of participation. But if you take a look at the fact that there are 1.55 jobs per each unemployed individual in this nation, it gives you a sense of what tightness actually means.
Payroll's top, just around the corner.
Actually,
you make notes.
Okay, I'm taking notes from Lisa. It's the only way I figure out what's going on. When we want to know what's going on in Washington, one of our most popular guests, Henrietta Trace, joins us. Economic Policy Director at Veda Partners, for years working with Martin Zweig as well, and just truly, truly knowledgeable about Capitol Hill. Henrietta, I want to go to the old days where the Senate Foreign Relations Committee was a big deal. It is now names Menendez of New Jersey, Raish, Cardin, Marco Rubio of Florida, and others. Are they like the Senate Foreign Relations Committee that we used to know?
I think when it comes to sanctions and Russia, there's a lot of similarities. I think if you asked them, they'd say this is history repeating. They are marching together in a very bipartisan way, which you probably couldn't say about any other committee in the Senate right now. So I do think there's a lot of similarities. And I think they have a similar objective here, which is speed.
What about on defense and Pentagon? Are they on the same boat? When in my youth, it was a bunch of Southern senators being sure the boats were built down south. At least that was a stereotype. What is the defense committee structure now and its efficacy?
It's funny you mentioned that. Homestyle is one of the best political guides of all time, talking about where you're building your ships, where your domestic outlets are to get support for the defense bills. On that piece, you have a bit of a differential in terms of Democrats and Republicans wanting to spend just slightly different sums of money in the annual appropriations bills. That's tied up right now and probably will be for the next few weeks. I think we probably see a short-term government funding bill that splits domestic spending and defense spending equally in order to get 60 votes out of the Senate and that committee. Those talks are much more bogged down than the sanctions piece right now, I would say. So maybe more of a near-term Senate phenomenon as opposed to the old school guys that used to work more closely together.
Henrietta, it seems like the Senate's going to pass these sanctions against Russia as a result of the Ukrainian conflict. Do you have any sense of the economic read-through if you start to game out what it means for oil prices, what it means for international trade, and what it means in terms of the alliance between Europe and the U.S.?
It's so interesting that you start with the relationship in terms of trade. We have talked for how many years now about the export control restrictions that the U.S. was prepared to put on China, also in a bipartisan fashion, against all those emerging technologies, AI, robotics, quantum computing, those pieces. Those are all components that the administration seized on immediately to stick through in conjunction with Europe to challenge President Putin. And those are pieces that I think they're going to continue building off of. You had the UN ambassador, the NATO ambassador speaking moments ago and a few days ago, if I'm not mistaken, on your program, talking about how this has really driven NATO together. And they are working on things that, a couple months back might have been very unrealistic to see some bipartisan work here or international work together on this. And so that's I think the trajectory that they're seeing for sanctions right now. When it comes to the economic feedback, one of the things that the Biden administration is doing and has made clear to members that they're comfortable with is there's going to be feedback with the big banks, with US institutions, obviously with Germany and the rest of the EU as they try to target Russia in different ways. I do think that one of the pieces that's most interesting is that everybody is working in conjunction together. And the sanctions are something that I think the senators have had on their back of their minds since 2016. So everyone's very prepared for any economic hit that this might extol in the U.S. or internationally.
Henrietta, I've missed you. It's been too long. Don't be a stranger. Let's catch up soon. Henrietta Trey's there of Vader Partners. Just seeing a headline across the Bloomberg from the Financial Times, actually. Aston Martin to phase out combustion engine-only cars, Tom, by 2026. If you hadn't realised already it's happening, Tom, where's Matt Miller when we need him?
What's the symbolism of that, John?
I guess they can move to hybrid. The language here is important, isn't it, Tom? The end of combustion engine-only cars
Engine only,
by
yeah,
26.
yeah,
But
hybrid,
for the sports car to move away towards electric, that's the direction of travel, Tom. Lisa's keen to jump in here, aren't you?
Yes, I am,
Lisa,
because this morning's news roll has been fascinating with respect to the energy transition. On one hand, you've got that Aston Martin news. On the other, ExxonMobil is boosting its spending on new oil wells by as much as 45%. So in reinvesting in some of these same fossil fuels simply because the demand is there and that really the issue has been the lack of ability to produce. So there's real tension here between the transformation
That's such a good point.
on the green side and the reality of today.
As they try and be a little bit more disciplined on the oil side of things. With crude at 88, though, the temptation is great. 87.72 on WTI. Coming up, conversation you do not want to miss. Patrick Harker, the Philadelphia Fed president, will be joining us on this program. Mike McKee is seated. He has his microphone on. He's ready to go. We'll be catching up with the Fed president very, very shortly, with yields coming in 2 basis points at 175.36.
You know, John, I saw that Agent Nomi, she drove her Aston Martin nice in the Bond movie.
Did you like that?
Yeah, I did like Agent Nomi. Yeah, that was great.
Good. I'm pleased it got your approval.
Thank you.
From New York, this is Bloomberg.
Hello traders, how are you doing today? The time is right now to place an order to buy Bitcoin, and the price I'm looking to buy 38,564. I'm going to place an order to buy Bitcoin at 38,564. Okay, if you're looking to trade Bitcoin today, please do so. Please copy my trade. Place an order for Bitcoin at this level. Okay? I'll speak to you later when the price will be filled. Stay safe, guys.
Pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor, y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue
innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City for our audience worldwide, this is Bloomberg Surveillance with Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your ISM data coming out a little bit later. Before we get there, equity futures positive. On the Nasdaq now up 1/3%. On the S&P 500, TK, up by almost 1/10.
Nice lift here, and of course, coming off of the UPS shock of really quite buoyant earnings. I think that was where the shift was this morning. This is something we take great pride in with the leadership of Michael McKee, Bloomberg Economics and Policy Director, also worst questioner of Jerome Powell that we know, and that is they are not just Fed presidents or Fed governors, but they are real people with true expertise. Patrick Harker is truly extraordinary and a voice for technology at the Fed. He is definitive in operations research. He holds the youngest endowed professorship at Wharton in their history. And all I can say, Mike, is when the Fed needs to understand technology and productivity, this is the guy they turn to.
Well, let's turn to Patrick Harker ourselves. And we should mention that along with everything else on your resume there, you are a voting member of the Open Market Committee as an alternate for the vacant Boston seat at the present time. So Tom does have to pay attention to what you have to say today. Let me start.
I don't agree with him on the questioning of Jay Powell. So, we'll start with that.
All right. Well, now I can take it out on you. Mary Daly, very firm yesterday. We are not behind the curve. Do you agree?
Look, there are risks on both sides. I mean, let's step back. I think it's worth a step back and say, why do we have inflation running the way it's running? Two things, supply and demand. The demand is something we can influence through monetary policy. The supply constraints, people and goods, less so. In fact, very little can we do about that. But two things are happening at the same time. So the question is how quickly, and this has always been the question, how quickly are the supply chain constraints going to leave us? And it looks right now like they're going to take some time. So slowing down some demand is what monetary policy does. I think is appropriate. I don't think we're behind the curve in that sense because we don't affect a big part of why there is inflation. That said, I do think we need to move now to try to control inflation. That is something I firmly believe.
Well, move now, but then move how often after that and how fast? Yeah. The questions out there, the 50 basis points in March, the 7 rate increases proposed by Bank of America. Where do you come down on that?
So let me step back from it. So we're going to stop the tapering in March. I would be supportive of 25 basis point increase in March. Could we do 50? Yeah. Should we? Well, I'm a little less convinced of that right now, but we'll see how the data turn out in the next couple of weeks. And then when we're sufficiently away from zero, we can argue what above zero is, 125 basis points, 100 basis points. Then we start normalizing the balance sheet, start bringing the balance sheet down, which of course will also reduce accommodation. So it's really a two-step process here. Yes, we want to increase the Fed funds rate, which is our primary tool of monetary policy. At the same time, we want to start removing accommodation by shrinking the balance sheet. Both things have to happen in tandem in my mind.
Let's step into March and then build on your comments on the balance sheet, President Harker. On March, tell me the data that you are looking at, the data that will influence and shape that decision. A lot of people de-emphasizing Friday's payrolls print. We would all love a deeper understanding of whether you will look at that, how you would process that information given the Omicron scare as well, and additionally the data you'd be looking at going into the March call.
Yeah, so I heard some of the comment earlier from some of your colleagues or people who have tweeted about maximum employment. I think we're there. So really, this is an inflation story in my mind. And so what we're looking at is the signs that inflation, at least the precursors to inflation, like the supply chain issues, are starting to mitigate. If I don't see that,
Okay, traders, as you can see, position opened. Well done, all of you guys who who copied this trade, who decided to follow me today. Well done, you're in. We have position open for Bitcoin. Stay with me and we will close this trade together. Okay, I'll speak to you later, guys. Well done, all of you guys who decided to trade today Bitcoin.
The policy. We can't define a path right now and just stick to it. We've got to look at the data. And to me, primarily, it's the inflation data.
Can we keep building on that then, just on the inflation front? Do you need to see deceleration into March? Is persistence enough to worry if it persisted at this level? Would that worry you enough? Which one would it be?
Sure. I mean, I think persistence would worry me, continue to worry me. And that's why I'd like to see some signs, whether it's actually in the inflation numbers themselves, or as I said, in the precursors to inflation, that we're starting to see some easing of the pressures on wages or the supply chain constraints, et cetera.
What would you be looking for, President Harker, to possibly go 50 basis points? You said that, should we? That's less clear. Could we? Sure, absolutely. What kind of inflation read?
I think we're looking at a fairly significant spike from where we are now on inflation. If inflation stays where it is right now and continues to start to come down, I don't see a 50 basis point increase. But if we see a spike, then I think we might have to act more aggressively.
Are you concerned about the possibility of a hard landing being dismissed by a lot of Fed officials as probably unlikely, and this sort of confidence that they can engineer this?
Look, it's always a risk. I mean, let's be clear, it's always a risk. But I think we actually can do this if we really listen to the data and act appropriately. And again, my first step in acting appropriately is March. Stop the balance sheet purchases, and let's start raising rates by 25 basis points.
You, in 2020, adopted a new framework which made you state-dependent in terms of moving interest rates. Is that out the window now? Are we back to forecast-dependent since policy works with a lag?
Well, you always have to take that into account. But I think in this case, if you just look at the states of our dual mandate, we're there. And so we need to act. I mean, I don't, with respect to employment, this is one of my pet peeves. Look, we're probably going to have a bad jobs report in the end of this week. I mean, just because of Omicron. I mean, it's just simply because of Omicron. That said, I mean, and the media will say, and I'm not criticizing the media here, but it'll say the economy only created X number of jobs. No, the economy has created millions of jobs. We just can't fill them. It's a supply constraint. And that is not what monetary policy affects. So I think with respect to employment and with respect to inflation, we are there at our dual mandate, and that's why we need to act.
Well, let me ask you the question I asked Chairman Powell, and that is, what is your goal in terms of the inflation rate? It was understood that you were trying to average 2% over time, but he told me you're not trying to go below 2%, which you would have to do to get an average.
Yeah, I mean, at some point we'll go below 2% would be our guess, but we don't have to rush it. I mean, if we can get it in the ballpark, that's good enough. I mean, the measurement error is sufficient where if it's slightly above or below 2%, 2.5 to 1.5, I worry less. Right now, where we are, it is clearly a problem.
President Harker, I want to try and move the dial on the balance sheet conversation because we really don't have much clarity. And some banks on Wall Street are throwing out some pretty big numbers. Matt Lazzetti at Deutsche Bank is talking about $1 trillion of reduction next year, $560 billion in the back half. You're at about 4 hikes for 2022. How does the balance sheet conversation influence that decision? Is it separate to your rate hike call? Does it complement it? How does it fit in?
Yeah, that's a really good question. So in my mind, we have to reassert that the Fed funds rate is the primary tool of monetary policy. But recognizing that the balance sheet clearly has an effect, it adds or removes accommodation. So I would like to get the Fed funds rate up and then start a process of normalization that is like watching paint dry. That is, put it in motion, start reducing it. That reduction will be faster and steeper than the last time we tried it, until, of course, all this happened. And just because the balance sheet is so much larger. But we put that in process, we start reducing the size of the balance sheet and use the Fed funds as the tool that we need to adjust if we need to adjust. No question about that.
Do you think that you will need to sell assets to get the balance sheet down, particularly on the mortgage side, since the Fed says it wants to hold primarily treasuries, and you'll be stuck with mortgages for 30 years if you don't?
Yeah, maybe. I mean, this is something we're actively looking at right now. No decisions have been made on the balance sheet question. It is one where we're going to take our time. We have some time here right now to think about it, to model it. Could we sell assets? Possibly. But right now, I wouldn't commit to any of that until I see the analysis.
President Harker, just finally from me, do you have a number in mind when you think about balance sheet reduction on a monthly basis, one that would make sense? Can you give us some insight into your real-time thinking about this?
Yeah, not yet. I mean, I think we have to let that play out, like I said, the analysis. And what matters to me more right now is that we're committed to doing it, and that we're going to commit to doing this for the long run. That is, it's going to take some time to get balance sheet back to whatever normal is. And I know there's an argument about what normal is, and there should be an argument about what normal is, because we're not the economy we were before we came into the pandemic. So I can't put a precise number on it, but I think what matters now is that we are committed. I can say I am committed to making sure that we start this process, possibly later this year or early in 23, and then let it run to get back to normal.
This is a real-time conversation. You guys are looking for tons of flexibility. Patrick Harker, just a final one from me. Are you satisfied with how the market is discounting some of the communication coming out of the central bank right now?
You know, the markets will interpret what we say, how they want to interpret it. And I think we can be as clear as we can be. At least I'm trying to be as clear as I can be where I think policy should go. And I think it's really important that the market participants are seeing the same data we're seeing. We're not seeing anything different than what they're saying. It's all a question of interpretation. And that we can disagree on. But at this point, we need to let the data play out.
President Harker of the Philadelphia Fed, fantastic to catch up with you, sir. Thank you very much for being with us. Alongside Michael McKee, Tom Keene, Lisa Bramberson, Jonathan Ferro. Mike, let's start right here, teeing up March and a conversation further down the road.
Yeah, I don't think that there's any question that the Fed is going to be raising interest rates in March. And it does look like, from the preponderance of comments over the last 2 days, that they're going to go 25, that the 50 basis point is kind of out the window unless we get some sort of shocking news. And you heard President Harker say he expects a bad job report. So that would reduce, in theory, some inflation pressures. We'll see when we get the CPI later this month. But right now, it looks like we start with 25, and then they keep looking around to see what is happening with the economy.
Tom, that's the important one for me this Friday. It looks like you can just ignore that one, the payrolls report coming through this Friday. It's not going to change the mind of some of the people on this Fed going into March.
Yeah, I'd go with that. I thought what was important there from the gentleman of operations research is he's glued to the x-axis and extending out. And the phrase like watching paint dries, John, that's a really important comment from Harker. Martha Stewart just informed me some paint can take 72 hours to dry. This paint may take 72 quarters to dry.
Years and years and years. Lisa, can you allow a central bank to come down at some speed, maybe, and compare that to paint drying?
Well, they're going to try. I don't know if anyone is going to buy it in terms of what the ramifications are. I think that the most interesting thing that he talked about is this is not a jobs-driven Federal Reserve at this point. It is completely the inflation data, because this is a tight labor market. And if we get a disappointing report on Friday, it will be because there are not enough people to fill all of those job openings.
Just setting us up to ignore payrolls Friday, so take a long weekend, Tom. Take a long weekend. Hey, Mike, fantastic as always, mate. Thank you for bringing us that interview. Mike McKee there alongside Tom Keene. Lisa Bramberson, Jonathan Ferro, Seema Shah coming up at the top of the hour. That conversation 20 minutes away on this equity market from New York as we kick off a brand new month. Good morning to you all. This is Bloomberg.
failed to fundamentally change the sort of infrastructure of hospitals and medicine generally in India, or was this just a short-term phenomenon and things reverted back to the mean?
So it did change. I think from a preparedness standpoint, how the hospital infrastructure sort of geared up for it, and whether it was oxygen requirements. I think most hospitals have put up liquid oxygen plants, temporary plants. Some have put up permanent plants. I think the capacity for oxygen and other, medicines and supply chain has been augmented, enhanced. So from that standpoint, I think there's been expansion in capacity in infrastructure. We've all sort of seen how far we can stretch the envelope.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
I'm here at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Supply chain challenges. We believe it's going to be prolonged into 2022 and to 2023. Labor challenges. We have to win talent. We have to fight for talent. We're making investments. But that's just, our mindset is that's the new normal. That's not a disruption. That's the new normal for the near term and the medium term.
Adrian Mitchell, he's Macy's Chief Financial Officer, and of course he's seen the resurrection of Macy's here, doing way better than they have over the last tumultuous decade. Bloomberg's Chief Future Officer program, that's on Bloomberg.com and out on YouTube as well. This is a joy. Sebastian Mallaby is eclectic, to say the least, with the Council on Foreign Relations, a senior fellow. You know him from work on Mr. Greenspan, work on the hedge fund industry. And now he is tackled in a must-read book for this summer. If you're part of Global Wall Street and you feel as ignorant as I do, then you must address Sebastian Mallaby and the new and important The Power Law with a beautiful yellow cover. You can't miss this on Amazon or at your local bookstore. On venture capital and the making of our new future. Sebastian, congratulations again on providing clarity on something mysterious. When you started this project, what was the biggest mystery for you of this strange phrase, venture capital?
The biggest mystery, Tom, was how do you even begin to allocate capital when you are dealing with startups? There are no quantitative guidelines. You can't discount the future cash flow because there's no cash flow. You can't do book to value because there's no book value. All you have is two-legged mammals walking into your office with a dream. So just that sheer lack of guidepost, intellectual blank sheet, that's what drew me into the subject.
What I find fascinating is from the beginnings, and you cover so well Kleiner Perkins and all of it and the stereotypes we all hold, out to the present day and say SoftBank, and you touch on that later in the book as well, has venture capital then even remotely the same as venture capital now as represented by SoftBank?
Well, SoftBank is a special case, and Masayoshi Son is a special person, right? I mean, he has such a willingness to take crazy risk. You know, he blew himself up in the NASDAQ collapse, but at the same time, he'd just taken that position in Alibaba, which went from 20 million in 2000 to 58 billion 14 years later. So I think he's sort of a case unto himself. Maybe the question is like Tiger Global, right? That kind of growth equity investing, which didn't exist maybe 15 years ago, has now become front and center. And that is a new departure for venture capital.
Sebastian, it seems like a lot of money has been flooding into venture capital with the promise that you outlined that even if a lot of the investments that you make are duds, there will be a couple real shining stars that absolutely are torpedoed to the top. Is it different now to find those? Is it harder to find those at a time when the behemoths of the world, I'm thinking the Googles, the Facebooks, et cetera, are buying up so many startups before they even get off the ground?
Well, one of the cool things about this space is that when you're doing the really early stuff and you're writing a check for 5 million, 10 million, you're not going to get the big growth players involved in that. It just doesn't move the needle for them on their huge portfolios. So if you're doing the early stage stuff, you have a kind of timeline in your mind of 5 to 7 years before your exit. Whether the stock market is up or down or sideways, whatever happened to interest rates, who the president might be, doesn't matter. So you can just basically look for what you think is going to be transformative technology. Yes, you will get it wrong most of the time because that's the nature of the business. It is a power law business, hence my title. But you hope that you'll get 1 or 2 bets out of 10 will be exponentially right, and that will more than make up your whole portfolio.
Sebastian, a lot of people are talking about the productivity gap in the United States, in the modern world, and basically we are not seeing a huge productivity boom. And they say, well, this could potentially change if there's some massive technology.
Okay, traders, as you can see, we need to place stop for our position on Bitcoin. And I'm going to place stop for our profit 0.5%. So 38,564 plus 0.5%, it will be 38,757. Okay, so I'm going to place stop. So in this case, I will be sure that if price will move down, I will not lose 757. I will not lose money on this trade. Okay, guys? So please do also, please place your stop. And it's probably will be one of the shortest trades I made for quite a while. But as you can see, it's profitable. In our case, we have already were in profit £500. In your case, that's all about how much you decided to invest when you decided to trade Bitcoin. Some people call it money management, okay? If you want to get the strategy or find out how we trade, you need to go to company.co.uk and you can find the strategy that you can purchase from there. Okay, guys? I'll speak to you later.
This private, hands-on venture capital type of investment is key to the progress of an economy where you have a lot of intangible capital. We used to have capital goods that you could drop on your foot. Now it's services, it's knowledge, it's software, it's intangible. We need the venture capital, but unfortunately, the little guy can't participate.
We've got 10 more questions. We don't have enough time. Sebastian Mallaby, Counsel on Foreign Relations. The book is The Power Law of Venture Capital, the Making of the New Future. And what's important is and there's a lot of notes. It's not that intimidating, folks. On radio, it's a little bit thicker than normal, but all I can say is this will be the definitive Wall Street read this summer. And Lisa really addresses not only the biography and history of venture capital, but some of these themes forward.
It's telling at a time when a lot of people are looking to venture capital to possibly give you uncorrelated returns from a market that has been absolutely pocked by turmoil and will likely continue to be over the next few months. I just have to go back to that Patrick Harker interview, Tom. The idea that really the labor market is not the consideration right now. It is incredibly strong according to Fed members. It is the inflationary read, which is setting us up, as John said, to just ignore what we get on Friday in terms of the jobs print for January.
Well, yeah, but there'll be the wage dynamic, and I think that any surprise on wages will adjust that. Again, in inflation, I would suggest, Dr. Harker would suggest it's about goods inflation coming in is the hope, and at least that's open. Lisa, look at the tape right now with the green on the screen. I do want to do a correction here. Not a correction, but a clarification on a simple banner I wrote this morning on AT&T. Their cash dividend was $15 billion large, and off of the transaction on Warner Discovery, it was modeled out at $9 billion, and they surprised a bit today with an $8 billion statistic on a dollar, I believe $1.11 dividend, and it takes the stock down 6% this morning. We thank AT&T for their comments this morning. What our comment is, green on the screen, we go from red to futures up 3. NASDAQ up 0.2%, and the VIX to me is the story of the week from a 28 level yesterday, now into a stunning 24.36. Stay with us on Bloomberg Television, on Bloomberg Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Kicking off a brand new trading month from New York City this morning. Good morning, good morning. Slightly positive on the S&P 500, up by 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York City, we begin with the big issue, closing the book on a messy January.
I'm completely exhausted.
The volatility to start the year.
It's like going on a roller coaster.
Historic intraday volatility.
Reverberations, volatility, opportunities to reset portfolios.
The question that we have to ask is, what are the underlying storylines?
We're at a turning point, a sea change in terms of Fed policy.
All options are on the table.
We had about 3 Fed hikes priced. Now we're closer to 5.
Bank of America at 7.
Even a 50 basis point move coming out of the gate.
Higher volatility simply represents a broader distribution of outcomes.
This intertwinement of the Fed and the markets is at an all-time high.
The distribution of outcomes is far wider than people were thinking.
That always comes with a healthy dose of volatility.
That's what I think the market is grappling with.
Joining us now to discuss is Invesco's Matt Brill, Carson Group's Scott Kuby, and Seema Shah of Principal Investors. Seema, I want to come to you. What we've just seen in the first month of this year, was that a growth shock or was that a valuation reset?
I think it's more of a valuation reset. I think the market, we've seen, of course, it moved very far in terms of its interest rate hike expectations, but it's moved even further in terms of its expectations for a growth slowdown. I think it's moved too far, and this is where hopefully this is going to set the stage for a bit of a stabilization from here.
This is not a growth scare, the words of UBS. This is a valuation-centric sell-off. Seema Shah, they agree with you, not a signal that investors are pricing in a prolonged slide in global growth. Matt, do you agree?
Yeah, for the most part, I agree. This is all about valuation resets. I do think there's fear of a slowdown, but we're not actually having a growth shock anytime soon.
Seeing the cuts to growth, though, the forecast from Goldman came through yesterday. They cut the outlook to 3.2%, the consensus 3.8% for this year. Scott, where are you on the runway, the glide path through 22?
Yeah, I think that we'll see some definite slowdowns, mostly because of Omicron, and I think that's going to cause some challenges for the Fed. I was watching President Harker earlier in the previous hour, and they've got some real challenges where they can raise too much, raise too little. And so as we look at this overall environment, I think it's one of the most difficult environments for the Fed to face in a long time, and I think that's where we're getting a lot of the uncertainty that's caused us to have a very volatile January.
Scott, when President Harker said to us you can basically ignore Friday's print for the payrolls report, will you do the same thing?
Yeah, I think that we're seeing a very Omicron affected number from this standpoint. And so going forward, we really need to see what we can do to get the virus under control. There are just so many shocks, so many people that you bump into that are getting it. And that's really slowing things down. It's slowing down hiring, and it's slowing down the willingness of people going back to work. I think one of the points that President Harker raises, the economy is creating a lot of jobs. We just can't find people who want to fill them. I think some of that's temporary because of risk. Some of it's permanent as people have chosen just to reassess their overall relationship to work and maybe aren't working as much as they were going to before.
Matt Brill, is that going to be your approach into Friday's number 2?
Yeah, well, we're gonna ignore it the best we can. But he pretty much told you, yeah, this. I mean, we could see negative on Friday. It's certainly possible. But he's telling you that ignore it, look through. But the market's not. The market's going to jump all over the place on Friday. So it's going to be a volatile day. It's going to be a volatile month. It's going to be a volatile year. But we do think that the labor market is extremely tight. We think that the Fed's going to have to put a little pressure there to kind of have wages come off a little bit. So eventually, you're not going to have a 3.8, 3.9% unemployment rate. So we're going to be heading a little bit north throughout the year. But for now, just go ahead and try to ignore these numbers best you can.
It's been a hectic start to the year, that's for sure, for 2022. Wall Street all over the place now. Let's bring in Bloomberg's Kaylee Lyons for a whole lot more. Hey, Kaylee.
All over the place is a great way to put it, John. There is a wide gulf between where the lowest end and highest end estimate is for the S&P 500 at year end. The median is somewhere around 49.64, so about 450 points of upside seen on average by strategists. At the most bullish end of the spectrum is, of course, John Stoltzfus over at Oppenheimer. He's out at 53.30. The most bearish, as we know all too well, Mike Wilson over at Morgan Stanley down at 4,000. But here's the thing, John. Even those that lean on the bullish end of this spectrum have admitted things could go wrong, and that 4,000 level actually could become a reality. That was the message we got from David Kostin over at Goldman Sachs yesterday. He's down at 5,100, but said the risk up at 5,100, but said the risks are tilted to the downside given the repricing of expectations. He says that 10-year real yield moves up 60 basis points to 0%. 4,000 could indeed be possible. And an even bigger decline to 3,800 is possible should the real yield rise by 100 basis points. Not the central scenario, but still, it could indeed become a reality in theory. So that's one view, but let's also check in on what history tells us. And that basically is how the market does is going to have a lot to do with how the economy is doing. And since 1965, if the S&P enters a correction, it will historically bottom out after falling 15.4% if there is no recession present. If we are in recession, it's much worse, an average decline of around 36%. And given the economy is still growing, John, that would indicate that we only have about 9.7% more downside to come. That would put us in the 4050 to 4100 range. So a narrow miss of that 4,000 level.
Kaylee Lyons, thank you. About 25 minutes away from the opening bell. Are we witnessing a regime change from buying the dip to selling the rips? Crossmark's Bob Dole recommending investors sell into strength. Take a listen.
Be careful, be wary. If you have money to put into the stock market, only do it on weakness. And if you need to take money out, a green day is a good day to do it. Our view coming into the year is cash is king.
Cash is king. Scott, cash is king. I've heard this a lot in the last month or so, and let's be clear, I hear it a lot when I see an equity market pulling back. I want to understand whether a cash position at the moment makes sense to you after hearing cash is trash for so long from Ray Dalio over at Bridgewater.
Yeah, we always have some cash in portfolios, but I don't agree with Bob there that cash is king. From our perspective, the thing that we're seeing the investors need to focus on most is they've probably made a fairly large amount of money from their equity positions and also likely sold some of those bonds off given the overall low yields. It's getting your portfolio back in line with what your core risk tolerance. I think that's the biggest risk, and I think that's some of the selling pressure that we're seeing is people looking and go, wow, things got a lot more volatile. You're giving them a reason to look at it. And I am a little bit more aggressive than I wanted to. I think that's a big cause of some of the selling pressure we've seen in the market.
So, Scott, what you're speaking to sounds like rebalancing. So just make it really simple for us. How would you suggest they do so in the coming weeks and months?
For our advisors, we share with them is make sure you're on plan, understand where you are in relation to that, and then reassess it too. Yields still aren't great, so it may be something to look more for some alternatives to mix in as a small portion with a larger fixed income. So there's some creativity, but yet at the same time, it gets back to goals. And a lot of times, investors may be a lot closer to the goals than they thought they were because of the really strong equity returns we've seen in the last couple of years.
Matt, equities have taken the headlines over the last few weeks through 22 so far, as you know. To what degree are we starting to see some pain flush through credit as well?
Yeah, corporate credit's had a really tough start of the year. You've got investment grade down about 3%. You've got high yield down 3%. Now, investment grade, most of that's coming from rates going higher. We look at cash as still not a good option. There are options to avoid interest rate risk while staying up in quality. Floating rate investment grade bonds are a great place to play right now. About 20% of the new issue market is in floating rate IG bonds. So there's more supply of floating rate. Despite rates going up, corporations are going to issue more because the demand's there. But you can also buy 5-year corporates around 2.25% right now, and you basically have to be at 3% at the end of the year to not make money there. So there's ways to play this market now that weren't there just 3 months ago that we're actually starting to get excited about.
The Federal Reserve is talking up balance sheet reduction, higher interest rates. You've seen the claim that we could get 7 maybe later this year from Bank of America, as low as 3 over at Barclays. That's a wide range, Matt. The last time we had a Fed that took things too far, back end of 2018, it got messy in credit. Are you confident, constructive on the asset class in a way that you weren't back then, Matt? Do you think we're largely more insulated this time around?
So I'm still fairly nervous about credit over the near term. I think just technicals have a chance to be sloppy here. Fundamentally, corporations are in a lot better shape. You're looking at AT&T today. why are they cutting their dividend? Why are they spinning off Time Warner? It's because they're paying down debt. So there's still some good things that are happening now that were not happening in 2018. So it is a very different corporate fundamental landscape. But the technicals are the same. And in 2018, the foreign buyers stepped away because hedging costs started to get more expensive. And that's what we're going to be getting the back half of 2022. So I have more concerns about technicals now than I do fundamentals, because fundamentals are still rock solid. So that's what helps me sleep at night in the current time.
A lot of people struggling to do that at the moment. Matt Brill sticking with us alongside Scott Kuby. Seema Shah, we lost connection with Seema. Going to try and re-establish that and get her back on the programme, going into the opening bell. Let's get you some movers. A lot of earnings coming up after the close. Let's get to Abby for more. Hey, Abby.
Hey, John. Well, a lot of earnings indeed. And starting out with one that has reported in the pre-market. Let's take a look at the shares of UPS, absolutely soaring, on pace for the best day since April. This after they put up a very strong quarter. They raised the dividend by 49%, gave a forecast well above the street. They see annual sales of $102 billion. Importantly, margins at 13.7%. Again, one of the best days in a long time right now in the pre-market. ExxonMobil also a very good quarter, up 0.5%, the biggest profit since 2014 as energy prices rally in a big way. And then AMD after the close, as you were alluding to, up 2.73%. The street is looking for greater than 30% year-over-year growth on both the top and bottom line. The bigger story will be about the share gains, the competition against Intel. Are they continuing to win? Plus, we'll gain a sense for the health of the corporate IT spending picture and personal PCs as well.
Abigail Doolittle, thank you. Coming up on this programme, State Secretary Antony Blinken preparing to speak with his Russian counterpart.
But with Russia's continuing its buildup of its forces around Ukraine, we are ready no matter what happens.
That conversation up next.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Bloomberg is fastest with the numbers and analysis.
This is a mighty crash.
What to buy and what to run away from.
Bloomberg, the fastest numbers and analysis you trust.
He
is not de-escalating. At one point, he had claimed he was de-escalating, that they were moving forces back. That's not the case. That's not what we're seeing. And for that reason, we do have that decision that the U.S. wants to keep those forces on alert. And that's something we can do for quite some time. I don't think any of us are worried about that, but that those troops will be ready should we need them to defend NATO territory.
Western allies continuing their diplomatic press as Russia pushes back on allegations that the country is planning an attack. The Russian representative to the UN saying the following: in the statement of my American colleague, there was a significant hodgepodge of accusations of aggressive actions by Russia, but no specific fact given. Joining us now from more team coverage, Bloomberg's Anne-Marie Horden in Washington and Maria Tadeo over in Brussels. Maria, we're expecting the news conference to begin with the Russian president any minute now.
Yes, and Jonathan, and this is really the moment where we're going to hear from the man himself. Remember, Vladimir Putin received that report last week from NATO and the United States addressing some of his... He said he was going to take the time to study this document, to read it in detail, and then he would respond. Now, I know you mentioned there, of course, Russia saying that they have no intention of invading Ukraine. We've heard this for weeks, but the reality is the troops are still stationed, 100,000 men stationed in eastern Ukraine. At one point, you have to make a decision whether you pull them back or you engage them in combat. I would also stress, and this is very important, it's not just eastern Ukraine. We're also seeing military exercise in Belarus. This is the easiest and the fastest way into the Ukrainian capital. And Jonathan, by the way, you know, we talk about whether or not we could see a Biden-Putin summit. What we are seeing, however, is Vladimir Putin on the phone with French President Emmanuel Macron. Remember, the Russians do believe that the French are Russophile in their ways, that perhaps there's a diplomatic way and they could be softer on this. So they are working the phones with the French.
AMH, what's the latest in D.C.? What's the big take?
Well, we're waiting for that meeting, of course, with Sergei Lavrov and his counterpart, Secretary of State Antony Blinken, and potentially we can get a little bit more clarity because, Jonathan, frankly, it's been confusing in regards to what the Russian written response was to the U.S. response, because Dmitry Peskov has said that that document that was sent last night that we have word of from the United States government was regarding something else. And President Putin is still mulling over exactly what he wants his response to be to the U.S. in terms of the security concerns and the demands President Putin has made. But I think it's really important that we're going to hear from President Putin himself today. He has not publicly discussed Ukraine since before Christmas. So we should hear from them, given the fact that we are having a whirlwind of diplomacy. Maria just pointed to President Macron. But President Putin has also spoken to Mario Draghi of Italy. He's about to speak to tomorrow Boris Johnson of the United Kingdom. There's a ton of diplomacy, but we're going to hear from President Putin himself today. And I think it's important deciding what potentially he signals in this press conference as he stands alongside Viktor Orban.
AMH, this is the big focus right now. Let's talk about what we've not discussed, you and I, for weeks. That's the domestic push on the fiscal side. Brian Deese, the National Economic Council Director, we're seeing a lot more of him recently on MSNBC, a US network, about an hour ago, talking down the jobs report this Friday. Most people are. Where's the big push domestically?
Yeah, Jonathan, we should know, but he potentially maybe is hitting more of the television screens after you made a point that we haven't heard a lot from the administration. There hasn't been a huge push on this economic front. Friday potentially is going to be a rough day for them as they are dealing with higher inflation, which we know is a political nightmare for this administration. 7% print. It is what all the polls are talking about. And as they gear up for the midterms, this is what consumers are focused on. They have been pushing to the story of getting to full employment, a 3.9% unemployment handle. It's very close to where we were pre-pandemic. Potentially, this could be another headache from them in this Friday jobs report. It does seem like they are trying to get ahead of that coming out on the networks leading up to that report.
The correlation, not causation. Just to be clear, I do not schedule the director of the National Economic Council and his TV appearances. Larry Kudlow can testify to that. AMH, thank you, down in Washington, alongside Maria Tadeo. On the latest transatlantic story, Matt Brill, Scott Kuby, Seema Shah back with us. Seema, let's talk about how strong this economy is right now. David Rosenberg of Rosenberg Research said this. This claim from the Fed on how great the economy is doing compared to late 2015 is nutty. What would things look like today, absent an 11% deficit to GDP ratio, 2.8% back then, and a $9 trillion balance sheet at the Fed, twice the size of back then? Seema, what's your response to that line from David Rosenberg?
I mean, look, it's all true, but it's a strange thing to compare to. We've had a huge pandemic. I think the important point about the deficit is actually that it probably is going to prevent the Fed from tightening all the way that it potentially could. You know, the terminal rate of a 2.75%, I think people are worried that it might not be able to get there. And maybe one of the reasons for that is the size of that deficit. You know, the amount of kind of in terms of the debt repayments that would be entailed if you do get a significant rise would be a concern. But that's actually one of the reasons why we don't see the Fed moving that aggressively. I mean, the 7 hikes that people are talking about in 1 year, we think that they will tread considerably more cautiously because of the aspect of that deficit.
One thing that stood out for me in the conversation with President Harker about an hour ago on Bloomberg Surveillance, Scott Kuby, was him talking about the balance sheet. He went through that it would be bigger, quicker than perhaps last time, and then said, I want it to be like paint drying. Well, it wasn't like drying paint last time around, so if you're going to do this quicker, off a bigger balance sheet, Scott, how on earth is this going to be like paint drying?
Well, I think it's going to be quick dry paint, I guess, because they really want to accelerate that. And I think one of the things that you're seeing with the Fed is very consistent talking points from who's ever out there. And the point that I think they're raising is they made a mistake last time by not shrinking the balance sheet near enough, got another crisis before they'd really made serious progress and had to inflate it quite a bit. I think they have to do that. The other piece, if you'll remember from the last time that we went through this process as well, is they started to invert interest rates. And I'm very confident the Fed wants to rate that. So I avoid that. So I agree with Seema from this standpoint is fewer rate hikes than a lot that people are expecting, but using the balance sheet reduction in order to allow long-term rates to drift up so that they avoid that overall interest rate inversion.
And Matt, do you see the same thing evolving at this Fed? Using the balance sheet as a tool to shape the yield curve? I haven't actually heard a ton of it from Fed officials.
Well, I thought you asked a great question. You wouldn't take the bait on whether they would sell, and I think that's the biggest question that it's on everybody's minds is that if you have selling of $30 to $50 billion of mortgages per month, that has to have an impact on the market, and we just don't know yet if they're going to do that. Yes, they're going to let some roll off. We all know that, but he also mentioned that maybe, I think he said 2023 for the balance sheet reduction, and then he said late in the 2022. So he was a little further behind than I would have thought. I would have thought he would have said June. Now, again, it's not necessarily all his call, or it's obviously not all his call. But I think what we're going to see here is they're going to come out in June and they're going to start letting things run off. And I think there's a very, very high chance that they're going to sell assets, particularly on the long end, in order to make sure that we don't have an inverted yield curve. And I think that if they hike 7 times and have to sell assets, this is a complete mess for the market. I think that would be a worst case scenario. I think what they should do is around 4 times and slowly lay out a path for what they're going to do, because it's only going to be watching paint dry if they tell you exactly what they're going to do up front. So we have to know it. All cards have to be on the table for us to see.
Matt, do you think they can say the word sell? And this market participants can internalize that message without seeing a mess on the screens in front of us?
So the only way they can say that is if they say that they're going to help us avoid an inverted yield curve, which is going to help us avoid a recession. If the market takes that, I think they won't. That could be a possible way for them to go through that transaction or those statements. Otherwise, no. If they use the word sell, everyone's going to get very, very nervous because we don't like to have uncertainty. And to me, if they give you a path for selling, maybe that's okay, but the way that it seems to me that they're going to be selling is going to be a case-by-case basis. Is if they find themselves behind the curve and having to adjust their sales around that. So it's a lot harder to lay out a plan for sales than it is for runoff. And so that's why I think if they have any sort of words of sales, the market's not going to like it.
Seema Shah, alongside Matt Brill, Scott Kuby. We need to talk about the financials at the banks. We've spent the whole year so far talking about rate hikes. You'd expect a big move in the banks on the S&P. We've had minimal returns. Yes, it's outperformed the S&P 500, of course, relatively speaking, but minimal returns when we're talking about 4, 5, maybe more interest rate hikes at the Fed. Futures this morning, positive 30 on the NASDAQ 100, just about positive on the S&P. Coming up in the morning calls and later, the attention turning towards Alphabet. That conversation just around the corner with Alphabet up by a 1.2% in early trading. From New York City, leaving behind an ugly month of losses for the equity bulls and teeing up a February and hoping, I know many of you hoping, we don't get more of the same. From New York, this is Bloomberg.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We're a month into this year, a single month. It's February, and we're already getting the downgrades. On the S&P 500, Ed Yardeni, early out the gate at Yardeni Research, from 5,200 down to 48 on the S&P. Futures this morning up a tenth. We're down 5% through January, the worst month going back to March 2020. That's the story in the equity market. Here's your bond market picture. Big adjustment higher at the front end. Are we done yet? I know you all feel that way. Up 45 basis points through the first month of this year on twos. We back away again from that 120 line in the sand after a very brief breach. We're back down to 116.51. That's the price action. Let's get you the morning calls. First up, Morgan Stanley upgrading Harley-Davidson to equal weight, $40 price target. Seeing a favourable setup with markets pricing in an overly negative outlook. Atlantic Equities upgrading Wells Fargo to overweight, expecting shares to rally with a supportive macro environment and earnings estimates remaining low. Positive there, 1.4%. And finally, Stifel naming Snap a top pick with the digital advertising sector, highlighting its stable and loyal user base along with potential upside to current forecasts. Coming up, the FANG stocks back at a spotlight with Alphabet earnings after the close.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Tuesday morning, good morning to you all as we count you down to the opening bell in New York City. The state of play as follows, up about 0.1% on the S&P. Last month down about 5%, the biggest monthly loss going back to spring 2020. It was even worse at some points. On the Nasdaq 100, positive about 0.25%, going into the open, up about 40. Switch at the board and get to the bond market. What a move we've seen year to date so far in the bond market on twos, up more than 40 basis points. Backing away from 120 and backing away from the highs of the year on tens as well at 177.68. In the FX market, going into the ECB this Thursday, euro dollar 112.72, positive 0.33%, with a move in the bond market which got a lot of attention a little bit early this morning. Your German 2-year, that yield trading inside the deposit rate of the ECB for the first time since 2015. That's important. We'll touch on that another time. In the commodity market, 87.61 on crude. Let's call it 87.60 and not mess about. We're down 0.7% on WTI. In the opening bell, about 40 seconds into the session, up 0.1%, not even on the S&P. Energy, the big winner of the year so far, the loser of the morning, down 0.5%. Utilities down 0.4. Consumer staples down a little more than 0.1. Communication services top of the pile, up 0.33%. We caught up with Alicia Levine of BNY Mellon a little bit earlier this morning, warning investors to be more diligent with stocks.
The year of buying an index or buying a sector call is going to be very difficult. You have to buy individual companies here with dividends, cash flow, and earnings power. It's a very complicated year. Yes, we're still bullish, and we do think the Fed cannot go 7 times this year.
Many others agree. That's the Bank of America call right now. Matt Brill, Scott Kuby, Seema Shah, still with us. Seema, I want to come to you. Why are the banks not working in the way that some people would like them to? Why aren't they working?
So although we've seen yields go up and we've got all these expectations for the Fed, first, we've had a flatter yield curve, and that is never a positive for banks. But importantly, most of the concerns this month have been about growth. And as we all know, for financials to outperform, we also need a really strong growth environment. And that's one of the reasons why I would expect the quality financials, so the ones with the really strong balance sheets, to Alicia's point, the positive cash flow, good earnings, should start to outperform as we go through the year. But it's been really interesting because actually that value rotation has been all about energy, not so much about financials.
Scott, same question to you.
Yeah, I think that we see, I largely agree with what Seema said, is that the flattening of the yield curve has robbed the financials of a lot of the strength. I also don't think we're going to see as much government support. And so one of the things we've seen was really strong balance sheets, great credit overall. Losses have really been minimized by the strong amount of government support out there. I don't think that's coming back. And so I think losses are also part of it, especially if the economy does experience any degree of slowdown.
Matt, the big banks have a big presence in the credit market as well. What are you seeing, Matt?
We've seen tons of issuance out of them this year. They've really flooded the market with just massive issuance, to start the year, and that's really weighed heavily on their spreads. So from our standpoint, we just have to digest that. I'm hopeful that they're going to take a pause here and maybe just really front-loaded everything out of fear of higher rates throughout the rest of the year. But from a fundamental standpoint, the banks are very well positioned, regulated well. So, we feel fundamentally fine. But again, the technicals are very poor in the banking space as well.
Are you thinking about expenses in a way that you haven't done, Matt, for quite a while? Just for the financials, for the big names we've been talking about over the last couple of weeks?
Yeah, I wish Invesco was bragging about how much they were paying everybody this quarter, but it's really only the banks that are coming out and saying that, and that's a real thing. I really think that wage pressure is something that's going to be putting a lot of pressure on these banks over the next quarter. I mean, they're basically telling you they're in a talent war right now, and that generally doesn't end well from an expense standpoint. So yeah, I mean that's something we're watching, and they have to have sales and trading that really come through for them this year, and M&A is probably going to pick up, so that'll help as well, but. They're gonna have they've got a higher bar to hit this year, that's for sure.
Matt, is there something you'd like to share with us? The floor is yours, sir. Something you want to say?
I'm very happy. I'm very happy.
Sure.
You're just seeing
sure.
a lot of eye-popping numbers coming out of there.
Matt Brillo, let it go. I wasn't going to go there. You did. So let's keep you out of trouble if we can. Looking at UPS up by a little more than 11%, 4 minutes into the session. A big day coming up for big earnings with big tech on deck. Alphabet kicking it off after the closing bell after falling nearly 10% from record highs. With us, and it's been a while. Can we bring in Taylor? Can we get some drums, some applause? Hello, Taylor.
Cellos, like we do in the afternoon, John. But I really love that you showed sort of the intraday and some of the longer term charts and really showed the swings, because Google and Alphabet, of course, have been sort of a bellwether for the overall tech sector as well, right? At one point, almost entering that bear market territory, but in the last few days, the big rally, sort of now finally out of bear market and maybe a little bit out of correction territory as well. Overall, you're still only down about 8% from some of those recent highs. Today, of course, some of that optimism really does continue. All of this, John, really brings up when we take a look and push forward to the fundamentals and to the earnings. Switch up the board and we really look at the composition. This chart tells it all. It is all about that top line revenue growth, really in the high teens really here in 2022, but it's all about that advertising business, right? You have a little bit of that cloud business, Waymo, and some of the autonomous driving in the quote other bet section. It does give it some exposure to some of those large end markets, but it's really all about that advertising business and the pricing and the core business that really is Google. Finally, if you change up the board though, John, a lot of people have been talking about, is this as good as it gets, sort of peak earnings? You've talked about the big rebound in the tech sector in terms of the price. What about the fourth quarter earnings growth? And that's where there are some questions when you trickle through to the bottom line. Tech, as you can see, their communications at the bottom of the screen. It is the second to last sector in terms of the fourth quarter EPS estimates. So, John, that's really where the focus is going to be this afternoon.
Taylor Riggs, don't be a stranger. It's good to hear from you. Look out for Taylor, Caroline, and Romain to lead you through the closing bell a little bit later on Bloomberg TV. UPS then getting your attention up by almost 13% now. Earnings very much in focus. To build on what Taylor just said, let's bring in Abby for more. Hey, Abby.
Hey, John. Well, it's pretty interesting because, of course, the last earnings report, inflation, the buzzword. This time, though, it's supply chain. Not surprisingly, UPS doing well both around inflation, margins, and supply chains. Those are the top mentions. Supply chain, 1,100. Margins, 1,000. Inflation. Encouragingly, John, COVID, the number of mentions on earnings calls, just 176 on this so far during this earnings season. Now, relative to supply chain and the concern there, we are seeing that influencing durable goods. These, of course, are costly items that are used for more than 3 years. Over decade after decade after decade, a nice slow build. But over the last 2 years, a parabolic spike up as inflation simply can't be controlled. Big ticket items hard to find. The most worrying type of inflation, though, John, could have to do with wage gains. U.S. employment costs rose by the most in 2 decades, up 4% in 2021. Unlike the cost of cars or even ice cream, clearly that's a non-durable good. Tough to bring that sort of inflation, those wage gains back in, John. That could be a real concern for the Fed.
Ice cream is my weakness.
Me too.
I just thought I'd throw that out there for whatever reason. No one cares. Abby, thank you so much, unless you want to send me ice cream, of course. Morgan Stanley's Mike Wilson says this: the aggregate earnings beat rate for the S&P 500 is back down to 5%. Guidance is a mixed bag, especially for cyclicals, where we're seeing weakness in forward-looking earnings revisions. Seema Shah, there is a difference when you say value over growth. Value is a big bucket. Morgan Stanley and Mike Wilson saying stay defensive.
Okay, traders, as you can see, position closed on Bitcoin, just right here. We have 500 pounds in profit. Well done, all of you guys who decided to trade. Just 1 hour, and we made a profit. For our strategy, please go to company.co.uk and you can get the strategy. Also, you can register for a webinar that dates already over there, so you need to register. And during the webinar, I will show you how I use the strategy. Strategy will be included, so you're all welcome. Okay, guys, stay safe. Let's move on. Let's see what other pairs, what other opportunity will bring us today. Okay, I'll speak to you later, guys. Stay safe.
Be generally strong for the overall market, but more leaning towards the value, less towards the technology names. That's a key theme we're looking at this year.
Matt, final word.
Yeah, I'm getting more interested in being bullish, but I'm not quite there yet. I think we still have a tough quarter. We need more clarity out of the Fed. And once we get that, then we'll be fine. But we got to get that clarity from the Fed sooner rather than later.
I'm looking for something on Tom Brady here as well, so I'm distracted. Matt, I don't know if you want to play with me on this one. Adam Schefter over at ESPN, the senior NFL insider, saying Tom Brady officially announced his retirement. I don't see that anywhere else. And I got caught out with this, Matt, over the weekend, as well as so many other people too. Have you got a take on this, Matt?
So I was at the 28-3 Falcons disaster in Houston. I saw Tom Brady come back. I saw him win another Super Bowl in Atlanta. He's definitely the GOAT. I would like to see him come back one more year, but I think he's probably done.
I think it is official. Tom Brady announcing his retirement from football. Matt, are you happy about that? For me, that's the reason I watch the NFL. I watch Brady and I watch the playoffs. And I was surprised that when I moved over here, really shocked, in fact, that America as a country wasn't a big fan, unless you were a Pats fan at the time. Matt, are you happy about this? Is this better for you?
No, it's not better for me. You want the great players out there. You know, Tom Brady's been fun to watch. I mean, I was in college when Tom Brady won his first Super Bowl, so you know, my kids are still amazed that he's older than me. But yeah, he's. I mean, it's amazing. And you want the best out there. But we've got some good young quarterbacks. You know, Mahomes is great. Allen, Burrow. I mean, you know, it's great. The great list goes on and on.
Matt Brill, Scott Kuby, Seema Shah, thank you to all three of you. I appreciate it. That headline just crossing, although we have done this twice in the last week. Tom Brady announcing his retirement from football. Coming up, the Fed's hawkish tone sending yields higher.
I would be supportive of 25 basis point increase in March. Could we do 50? Yeah. Should we? Well, I'm a little less convinced of that right now.
That conversation still ahead from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
this is an inflation story in my mind. And so what we're looking at is the signs that inflation, at least the precursors to inflation, like the supply chain issues, are starting to mitigate. If I don't see that, then I would be for a more aggressive policy. Right now, I think 4 25 basis point increases this year is appropriate, but there's a lot of risk here.
Fantastic to hear from the Philadelphia Fed President Patrick Harker there, speaking with Bloomberg's Mike McKee and myself a little bit earlier this morning. Mike joins us now for more. Mike, walk us through what we learned from President Harker going into this decision next month.
Well, it's important to recognize, John, that Pat Harker is a voting member of the Open Market Committee, at least for the time being, as a alternate for the vacant Boston Fed job. So what he says matters, and he did say 4 rate increases this year. That's 1 more than he had anticipated earlier in January. He also told you that maybe 50 basis points is a little bit too far for the first meeting. But it's all going to depend on the data. And that's the problem for the Fed. As Harker said, they don't know exactly what's going to happen, but they do know they need to do something. Here's what he had to say.
We're probably going to have a bad jobs report in the end of this week. I mean, just because of Omicron. I mean, it's just simply because of Omicron. That said, I mean, and the media will say, and I'm not criticizing the media here, but it'll say the economy only created X number of jobs. No, the economy has created millions of jobs. We just can't fill them. It's a supply constraint.
And that's the Fed's problem. How do they deal with a supply constraint when they work on the demand side? He did say that they do anticipate lowering the balance sheet starting maybe later this year or early 2023. Doesn't have a number in mind and isn't sure whether they will sell assets or just let them run off. But that has to be part of the solution as well. And John, we just had a number come over that confirms sort of what Pat Harker has been saying. The market January manufacturing PMI slips to 55.5 from 57.7. So you can see we are seeing some supply chain problems continue. This is probably based on rising supplier delivery problems.
Looking for the industry commentary on that as well, and the ISM a little bit later. Mike, I know you'll be breaking that down for us at the top of the hour. Mike McKee with the ISM, look out for that. Top of the hour, Guy Johnson. I believe Katie Lyons today alongside him as well. PIMCO's Mark Kiesel has this to say. Here's the quote. "We have reduced credit risk and raised cash in our credit portfolios over the past 3 to 4 months in anticipation the Fed would move faster and tighten financial conditions." Mark joins us now for more. We're lucky we get to join up with PIMCO's Mark Kiesel and talk about what's happening in credit and with this Federal Reserve. Mark, let's start there. Have you seen a sufficient tightening of financial conditions that you anticipated, or do you anticipate there's more to come?
Hi, Jonathan. Good morning. Now, there's probably more to come. I think what's interesting about this point in history is this is the first time the Fed is at zero, about 250 basis points away from neutral, when we're going to grow above potential, 3.5% this year versus 2%. You've got inflation, which even the Fed would admit is going to be above target by the end of the year. Core PCE is probably going to be around 2.9 by the end of the year. And labor market conditions are basically consistent with full employment. So normally when these 3 things are occurring, the Fed is close to neutral, which would be around 2.5. Right now we're at 0. So they're a long way to go. They're doing the right thing. I think they're adjusting. Inflation has been more persistent. It's because primarily supply constraints. But yes, they're going to have to raise rates, and we think they're probably going to have to raise 4 or 5 times this year.
And that includes balance sheet reduction, Mark?
I think they'll announce something this summer. You know, they're going to start with rates, and Powell indicated that that's their primary tool. But ultimately, we're going to go from this tailwind of not just the Fed, but other central banks around the world buying assets to not only not buying as many assets, but actually over the next 1 or 2 years, shrinking the balance sheet. Fed's balance sheet's $9 trillion. So I think ultimately that's going to steepen out these yield curves and put more of a risk premium. So for those factors, I think you want to still be defensively positioned for higher rates.
Mark, when you make the decision to raise cash, you've instantly got a second decision to make. When to come back in. Mark, walk me through the process you and the team would go through about when and how to deploy capital.
So really, you know, our logic for taking risks down 3-4 months ago was really a function of spreads being very tight, and also the fact that we were seeing inflation persist, and also these supply constraints linger. So we thought the Fed would have to adjust policy. The good news is that now you've got the market priced for 5 rate hikes. Spreads have widened, equities have come under pressure. So there are some selective opportunities out there right now, but overall we're running higher cash than normal because we are anticipating a more volatile period ahead, particularly with central banks around the world normalizing policy.
Mark, can we put some numbers on that? What's normal and what's higher than normal, just in terms of the cash allocation?
So, I mean, we've been bringing up our cash pretty consistently. Our funds are running right now over 10% cash, and we want to have that cash because we want to be in a position of strength should we get some volatility. The Fed will even admit this. It's a very unusual time. It's very uncertain. A lot of this slack could actually come back. We could see the labor force participation rate rise, and that could take the Fed off the table. On the other hand, these supply constraints could linger well longer, and that could even cause more rate hikes to be priced into the market. So we want to be in a position to capitalize on that potential volatility.
Mark, I want to talk about the volatility just a little bit more. I spent some time with you guys on the West Coast before, and I remember one thing that you said to me, and it was that we want to be liquidity providers, not liquidity takers. Are you expecting those kind of gappy markets that maybe we've seen on occasion in times before? Is this a price adjustment, a liquidity adjustment, Mark? What is it?
Well, I think ultimately it's when you have all these central banks being so accommodative for so long, it really has eased financial conditions. There's a lot of cash on the sidelines that has compressed spreads. You know, we're long-term investors. We look at long-term value. And so at these level of spreads, particularly where they were 3 or 4 months ago, we wanted to build up a lot of cash. You know, PIMCO tends to make a lot of money for clients in these higher volatility, higher volatile markets because we have the ability to do a lot of reverse inquiry with companies. We can provide liquidity when a lot of people don't have it or don't want to. So we want to take that counter trend. So we're prepared for that should we get more volatility in the months and quarters ahead.
Mark, I was just going through the so-called shopping list, the U.S. consumer, airlines, aerospace, banks, financials, real assets, real estate. Mark, why is real estate on that list for you at the moment?
So we want to have an implicit inflation hedge. And this really gets back to the comment I made earlier about supply constraints. We've seen supply constraints in the labor market, which is causing higher inflation. We're also seeing supply constraints in real markets, which is causing inflation. For example, we've underbuilt for a decade in the housing market. A lot of these apartments in high barrier to entry locations, they reset their leases on a very short duration. So they're the best beneficiary of higher inflation. They're also directly correlated to wages and salaries. So if you look at wages and salaries, you look at the ECI data, wages and salaries in the private sector is up 5%. So these apartments have been underbuilding and now demand is coming back. So we really like these hard assets, which are benefiting from higher wages and these high barrier to entry areas. So apartment REITs is a big opportunity right now.
One question I just got from a Bloomberg subscriber, and I'd like to throw it over to you, Mark, and you can answer. How does one get real estate exposure in a corporate bond fund? How do you go about doing that, Mark?
So we've been doing that over the last several decades by owning non-agency mortgages, which is really a pure play on housing prices. We do that through owning home builders. We do that through owning timber assets, apartment REITs. Building materials companies. So these are all inflation hedges. These companies I mentioned also have been able to pass through higher costs. If you look at the fourth quarter earnings, what you're seeing is labor markets are tight, companies are passing through higher costs, and the supply constraints continue. So this pass-through ability of companies, this is something we pay a lot of attention to on the bottom-up perspective, and we're owning those companies who have this ability to raise prices and pass through.
happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Mark, is that worth ignoring?
No, it's not. Obviously, the number could be 0 because of the Omicron variant.
Yeah.
But what I'm watching most closely is the labor force participation rate. Right now, it's at 61.9. It's low because basically you've had no immigration, you've had a lot of early retirements, you've had lack of childcare, and people fearful. Those things are going to change over time. And so we want to see that labor force participation rate move up. If it does, that potentially could take some of these Fed hikes off the table. If it does not, that means that the labor market's going to remain tighter for longer. And that, in turn, will cause the Fed to probably continue to hike rates.
Got it. Mark, awesome, as always. That's why I extended this
Thank
particular
you.
interview. Mark Kiesel. Send my best to the family. Mark Kiesel there of PIMCO. Time now for the trading diary. Let's whip through it. ISM Manufacturing at the top of the hour. Alphabet reporting results after the closing bell, followed by Meta on Wednesday, Amazon on Thursday. Plus, we get more PMIs and durable goods orders. Finally, we round out the week with Payrolls Friday. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps.